alongside Madison Mills this morning. This is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco.
Stock futures are slipping slightly into the red after the S&P 500 and the Nasdaq closed lower to kick off the week, with the Dow breaking from the pack, closing at a record high. So let's get to it, the three things you need to know to start your trading day. We've got Yahoo Finance's Jared Blickery, Josh Lipton, and Alexandra Canal with more.
Thank you, Maddie. Stock futures edging lower. Tech dragged both the S&P 500 and the Nasdaq lower ahead of NVIDIA's much-anticipated quarterly earnings report Wednesday. NVIDIA fell 2%, but Supermicro led the S&P 500's decline, closing down more than 8%. Investor hopes for AI putting pressure on chip stocks as we continue to track a rotation out of mega-cap names and into small caps.
And a C-suite shakeup. Apple is announcing a leadership transition. Luca Maestri will step down as CFO effective January 1st. Maestri will continue to lead the corporate services team and report to CEO Tim Cook. Apple says as part of a planned succession, Kevin Parekh, Apple's current vice president of financial planning and analysis, will become CFO. The announcement comes as the company we know deals with weakness in iPhone sales and growing demand to incorporate AI. Apple struggled in the first half of the year. They're now up 18%.
And Edgar Bronfman Jr., the executive chairman of Fubo, has dropped his bid for Paramount Global, all but guaranteeing Paramount will be acquired by Skydance. Paramount releasing a statement Monday confirming Bronfman withdrew his acquisition proposal. Paramount says a go-shop period outlined in its transaction agreement with Skydance Media has come to an end. That period allowed Paramount to seek out other buyers. Paramount says the Skydance transaction is expected to close in the first half of 2025. Shares of Paramount are trading lower this morning, down more than 4%.
Stock futures are stalling this morning after tech stocks dragged the S&P 500 and the Nasdaq composite lower on Monday. Now, meanwhile, the Dow is looking to hold on to an all-time high here. Let's take a look at some of Monday's biggest laggards, and starting here as we get into some of those major tech names that we'll get to in a hot second here. I just want to take a look at the move and the setup that we've got going into today's trading activity, and of course, kind of putting this in perspective of the last few months here, because there's some interesting data from Bank of America that really sets us up for the moves that we saw yesterday, talking about the seasonality that we typically see within the S&P 500. September, typically the weakest of the year here, and so as we're rounding out August, that's something to keep a close eye on. We've got important tactical support at 55.60 here as of right now. So even with these futures movements lower, as of right now, there's still a holding above that tactical level that Bank of America research is pointing out. All right, so all of that considered, the moves that we're seeing, of course, coming into the start of today's trading activity, we are looking at the futures for the S&P 500, the Dow futures as well. We mentioned that record high. That's down right now by about 0.3%. And let's get into some of those tech stocks, because you've been keeping a close eye on some of those large movers to the downside that we were seeing yesterday, and largely they were in semis.
That's exactly right, Brad, and really great context there too. But taking a look at the semis space, just a sea of Campbell's tomato soup here, right? You've got NVIDIA down over 2%, Broadcom also down over 4% here. You can see just the amount of downside pressure that we had in Broadcom specifically. But let's get to the big guy in the room that everybody's going to be watching heading into Wednesday's earnings. And this is critical for us to be looking at in terms of the context. NVIDIA down over 2% yesterday. You can see all of the volatility in this stock throughout the day. But that pressure that we saw in tech stocks, that could just be some kind of course correcting as we do head into that next big catalyst for the stock, which is, of course, going to be those earnings coming up on Wednesday here for NVIDIA. And it could really cement, Brad, either more positivity for the market or, like you said, that idea of September seasonality being a typically bearish month for markets. If we get a tough result from NVIDIA or the street doesn't like the results, it's not good enough, that could cement some bearish sentiment to come.
Yeah, just lastly, even while we're talking about some of these tech names, I was taking a look at some of the other downside movers that we had seen yesterday. You hit the big ones, which was really chips, but it was interesting to see a bunch of consumer names that were also in the mix. and moving lower yesterday. And for that, I'll just take a quick look at retail. We do have more specialty retailers reporting over the course of this week. Some of those larger outsized movers. I'm sorry for all the Uggs fans out there. Deckers was moving lower here. You also saw one of the names in Tapestry that joined it, of course, a consumer discretionary name. And then on the experiential entertainment side of it, Caesars, MGM, two of those experiential consumer discretionary names that you could continue to look at here. But ultimately, here's a larger look at some of those retail names. And Walmart not doing bad here, and Costco up by about 1.5% as of yesterday, at least. We'll throw some extended hours on that. We should have done that before. But anyway, there you're taking a look at that as we wrap up this portion and the setup for the trading activity today.
And as you can see, one of the big laggards in the retail space is Amazon, which is part of the broader tech drawdown that we were seeing to start off the week ahead of those NVIDIA earnings. But we're going to focus in on the broader tech story. And one story we don't want you to miss today, that shakeup in the C-suite at Apple. The company has announced longtime CFO Luca Maestri will step down at the start of next year and will be replaced by Apple's Vice President of Financial Planning, Kevin Parekh. For more on this, let's bring in Yahoo Finance Market Domination co-anchor Josh Lipton with more. And Josh, you are our resident Apple expert. Talk to us about what we need to know about this change.
Yeah, listen, there's a couple ways I think you can kind of gauge Luca Maestri's tenure at Apple, right? So Apple first announced that Luca Maestri was going to become CFO in March of 2014. Since that time, Apple stock is up more than 1,000%. Under his tenure as CFO, some of the metrics I think you'd have to call out what's been going on with the top line. Apple saw under his watch a doubling of revenue. But then there's also, guys, just kind of more of a broad strategic kind of vision and participation he had at Apple. I thought Amit Daryanani over at Evercore, who has, covered Apple for a long time, I thought Amit put it very well to his clients that really what you're remembering Luca Maestri for is really the commitment to financial discipline, to capital allocation, which in Amit's words has been a boon to investors.
I mean, that financial discipline went hand in hand with even how CEO Tim Cook likes to govern this business and looking across the market demand and not saying that they have to be the first mover, the first into market, but assessing what the demand profile of the market looks like for certain consumer tech products or services, and then saying, okay, now how do we leverage our ecosystem to just do it better than some of the other competitors out there? And you wonder how Kevin and Tim Cook, even though they've worked together for years at this point, how that will shift, how Kevin might put their stamp on the CFO role at Apple too, and what that difference may look like.
Kevin, though, also we should know, is a tested Apple veteran in his own right? Yeah. Kevin's been there for more than 10 years. He is one of Luca Maestri's lieutenants. He's a VP of financial planning, so he's been working like hip to hip with Luca for a long time.
Nice. And he will now be reporting into Tim Cook as well, so a change for him in terms of what his life is going to be looking like.
And I would say this too, listen, and just in the interest of full disclosure for the audience, I worked at Apple, right? I worked with Luca Maestri. I will say that, I think Maestri was one of the most impressive executives I ever met. I met a lot of executives.
Why?
But because he's just that smart, that hard-charging, and effective at his job. There was a reason why Maestri is one of the most well-known, well-respected CFOs on Wall Street, full stop.
All right. Yeah. Tall order to take over that position.
Right. For sure. Yeah.
Josh, thanks so much for breaking this down. Appreciate it. Yahoo Finance's own Josh Lipton. You'll hear more from Josh later on today on Market Domination. Everyone, sticking with Apple, it seems Wall Street is quite upbeat on Apple's latest succession plan. Joining us now with his take, we've got Tom Forte, who is the Maxim Group Managing Director and Senior Consumer Analyst here. Great to have you here with us, Tom. All right, so you heard the discussion and you've seen the news. So now what for Apple, and what does this transition signal to investors out there?
Yeah, so I think the signaling to investors is that, to me, Luca's biggest accomplishment was advancing toward net cash neutrality. So what does that mean? Returning more money to shareholders via dividends and buybacks. This is something that the incoming CFO, Mr. Parekh, is going to work towards as well. The other thing that I think is interesting is if you were to compare Mr. Maestri's tenure at Apple with Mr. Oppenheimer, his predecessor, it was much more challenging, to the extent that he had to deal with the COVID-19 pandemic. And when he led Apple's financial, they did not have the regular beat that they always had under Peter Oppenheimer. So I think Mr. Maestri had a much more challenging time when he was CFO versus his predecessor.
So what do we need to know, and what do investors in particular need to know about Kevin Parekh and the path forward for him? How prepared is he to carry the torch forward for Apple?
Yeah, so I think that Apple's got a deep bench when it comes to their financial or finance department. You saw that earlier this year when one of their executives left to be CFO of Sonos. So I'm not concerned in that regard. The other challenge, though, that Mr. Parekh inherits that Luca didn't have, at least at the beginning of his tenure, is the antitrust lawsuit. So these are challenging times for Apple on multiple fronts, from a regulatory front, including what's going on in the EU with their laws as it pertains to the marketplaces. And then it's a much more challenging time. There's a lot of competition coming out of China. So it'll be a challenge, but I think he'll be up for it given his long tenure at Apple so far.
What do you expect the cost discipline at Apple to look like under Kevin versus Luca, as our own Josh Lipton was mentioning?
So I expect the overall strategy to remain. So Apple, for the most part, has acquired talent. Their M&A has not been very big as far as large outlays of dollars. I don't think that'll change. I think they'll continue to return a lot of money to shareholders via buybacks and dividends. I don't think that'll change. The bigger question in my mind is, when do we see a change in the C-suite at the CEO level? So how long does Tim Cook intend to stay on board? He's done an amazing job. He's the poster child for the best CEO taking over from a founder. So I'm curious to see, when that'll take place. And I think that'll have much broader implications for investors.
It would seem to me, though, that the way that the past 24 hours and the planning leading up to this succession is a key indicator for shareholders of Apple about how a succession plan for Tim Cook could potentially materialize moving forward. What do you think operationally Apple may be applying from the past succession plan for the CFO level to the CEO spot?
Yeah, so I think that essentially Apple's an institution. I believe Steve Jobs implemented Apple University as a way of, teaching things that are core to Apple's DNA to future executives. So an amazing transition from Steve Jobs to Tim Cook. I expect the next transition to also go well, likely from someone who's currently at the company. And again, Apple's an institution. They're replacing from within at the CFO level. And I expect when the day comes, they'll replace from within at the CEO level as well.
While we have you, Tom, of course, the big event that we're going to be watching come early September is really going to be focused, zeroed in around the iPhone. How much of a needle mover do you expect this to be for consumers, but also for that to pass through and translate into better revenue, better production financially for the company and for investors?
Yeah, Brad, the challenge for Apple is they're going to introduce new hardware, but tell consumers that they're going to have to wait for the new software as it pertains to Apple Intelligence. So I think this may cause investors, or consumers rather, not to run to the store on the launch of the iPhone 16. And I'll be curious to see how the sales ramp in that regard, to the extent that maybe you have more growth in the December quarter than the September quarter, because Apple's introducing new hardware, but consumers are going to have to wait for the new software to do Apple Intelligence. So I think this quarter and this product launch will be unique in that regard.
All right.
Tom Forte, thank you so much for joining us. Really great points. And also, I particularly was interested in what you said about the CEO spot coming from within moving forward. Really important for investors to keep an eye out on those other names in the C-suite, given that advisement there. Tom Forte, Maxim Group Managing Director and Senior Consumer Internet Analyst. Thanks so much.
Thank you.
Now, the Paramount saga, thank God, it might be coming to an end finally, you guys. Skydance Media is set to become the new owner of the company after a millionaire dropping his bid. Paramount also officially ending its go shop period that allowed it to look for other bidders. Yahoo Finance's Alexandra Canales standing by with the full details. And Ali, you have done a great job continuing to monitor this, as I have started to get a little bit tired with this story.
You and me both, Maddie, and I really hope it's the end here, because it's been a very long, drawn-out process. It seemed to be over in June. Then Edgar Bronfman Jr. entered the arena and shook everything up. The go shop period deadline had been extended to September 5th due to his bid, but then just before the board's deadline, Bronfman pulled out of the deal late last night. And looking back here, the writing had sort of been on the wall that this bid was probably not going to work out, considering he had a tough time with the financing. He was forced to lure in multiple partners. That being said, though, he did have an offer valued at a sweetened $6 billion for National Amusements. That's the holding company owned by the Redstone family, which controls Paramount. Shareholder positions also wouldn't be as diluted as they would under the Skydance deal, which would presumably lead to less lawsuits. Now, this was probably a sticking point for Shari Redstone and one of the reasons why she entertained Bronfman's deal. But at the end of it all, we will see David Ellison's Skydance win out here. Ellison's roughly $8 billion offer would merge his company with Paramount. It would also provide $4 billion to purchase about 50% of Paramount's non-voting stock at a premium of $15 a share, or investors can choose to roll them over into the new company. Now, the Skydance team has already laid out a strategic vision that they want to see. That includes cost cuts. We've already seen layoffs underway with a goal of laying off 15% of the current workforce. The Skydance deal is expected to be completed in about a year from now due to various regulatory hurdles. So, Maddie, still plenty of time for things to really go south again, but at least at this point, Skydance is set to acquire Paramount Global. We are seeing Paramount shares down about 4% in pre-market trading.
All right. Allie, thanks so much. Appreciate it. Excellent update, and I hope this story is coming to an end as well. Guys, coming up, Kava shares sinking this morning. The CEO and key insiders feeling some action after selling shares. We've got the details on the other side. We just had the CEO on with us. He didn't tell us anything about this. He probably couldn't. But anyway, we're going to get into some of those trending tickers on the other side of the break. Stick around. Let's get to some trending tickers that we're watching. Zepbound maker Eli Lilly releasing a new form of its weight loss drug for roughly half of its usual monthly list price to increase access for patients without insurance. Joining us for more on this, we've got Yahoo Finance's Anjali Khemlani. You've been tracking this one.
I have, and Brad, to your point, it is specifically for those patients that do not have insurance, and that's actually the key portion of this, because we do know that that entails a lot of patients that are on Zepbound, the weight loss drug by Eli Lilly. We do know that it's going to be cutting its lower dose, that's 2 milligrams, to $399 per month, and then the 5 milligram to $549 per month. Now, previously, we'd seen the doses, which were in vials, about $1,000 a month, and that was where a lot of the pain point was for access. You can see on your screen the range of prices for the competing GLP-1s on the market. Reminder that Wegovy and Zepbound are the weight loss ones, so they're the ones which you have to keep an eye on in terms of the coverage, because that is where the biggest hurdle has been. Now, we do see some recent data saying that at least employers are starting to cover it. More than 50% have, according to some data, and so it really stands to be a question about whether or not Medicare will eventually get on it, or whether it will stay a self-pay commercial market. Analysts think that this is going to be the market for the weight loss drug, so this is really an important step, and we will have to see if Novo Nordisk responds for its weight loss drug, Wegovy, which was on the market much earlier and is priced higher, as you saw just a few moments ago. So this is already heating up, basically, the competition for GLP-1s without any new entrants. So Lilly had already come in under Novo Nordisk when it first launched the drug, and now cutting further and then introducing a single-use injector. So that's really interesting for the market, and we'll have to see how it continues.
Well, Anj, I think you bring up a great point, though, about the kind of price war that it might start to kick off amongst these companies. And this is when it starts to become good news for consumers, at least, because companies are competing to gain market share in the space by lowering prices. Is this the start of that era officially for weight loss drugs?
It could be. Lilly has definitely started. I mean, they shot the starting gun already with the launch of Zepbound. That was one of the things a lot of analysts had noted, was that they had started at a lower price. So they were already signaling that they're ready to compete. We also have to remember that CMS is keeping an eye, that's the Center for Medicare and Medicaid Services, keeping an eye on these drugs, all the GLP-1s, in fact, and Ozempic rumored to be on the 2027 target list. So already there is reason for them to reduce prices in hopes of potentially escaping being on that price negotiation list.
All right, Anj, thanks so much, as always, for bringing us your original reporting. We really appreciate it. That was our very own Anjali Khemlani. Meantime, shares of the fast casual chain Cava falling after the company's CEO and a slew of key executives disclosed sales of Cava shares, following a surge in the stock after the company's earnings report last week. And the CEO was actually on the show, as you mentioned, Brad, did not disclose this because he was not allowed to at the time. But
SEC filings, small things.
Yes, small things, SEC filings. But it's interesting to me the degree of the downside move here. This is common when executives sell off some of their shares. It's an indication of perhaps lack of long-term faith in the company. And it is interesting the timing of all of them as well, seeing that it's broad as well. It's not just the CEO, it's also members of the board and the CFO. But the CFO also sold like 5,000 shares, so it's not that much. And it's interesting to me just the degree of downside pressure. I wonder how much of it is related to this sale being sort of the sale of shares being sort of a selling opportunity for folks looking to take a bit off the top of Cava earnings here.
Yeah, lunch is on Brett next time after this share selling that took place here. 210,000 shares, roughly, just a little bit more than that, for $24.87 million. And I mean, this is the time that you would expect some of this selling to take place because of the run-up that we've seen in the stock. NVIDIA executives did the same thing. Cava executives looking at where the price action has led the inclination, at least, to take some profits for themselves as well. You are given these compensation packages, usually with stock options, for a reason such as this, to be able to add on to the base compensation that you would be getting here. And so, no doubt, good governance, good execution, and you got to take a little off the table when it seems right. And for all of them to do it at the same time, that might be a thought process of, okay, it just seems like on a governance basis, instead of all of us doing this in a scattered fashion, correction, maybe that there's a little bit more of an inclination to say, what if we just execute these at a similar options type of moment here? So you've got board members, the Kava co-founder and chief concept officer, Ted, plus the CFO, as you mentioned, all of them selling. But the price has been moving in the right direction for them, so kudos to them. All right, finally, Ryanair shares popping in pre-market as the discount airline CEO tells Reuters that the downward trend in average fares during the summer has leveled out. Shares are up by about 7% here, and this is an airline operator that's well known for really going after flyers that are booking last-minute trips, especially in Europe, and looking across where they can essentially kind of not even just nickel and dime, but have some prices that are more advantageous to the airline itself than to consumers that are booking last minute. And consumers were pushing back on that, which was directly impacting this company. So it's not totally out of the woods just yet, because there are still consumers that are pushing back on these prices, but they're saying the worst might be behind them.
And it's something that is not just coming from the mouths of these companies and the consumers. We're seeing it in the pricing data. When you look at inflation data coming from the likes of the Consumer Price Index, we have been seeing a consistent decline in inflationary pressure on airline prices specifically. Having said that, though, the CEO did note a couple of things that may be company specific to Ryanair here, saying that full year 2025 passengers could be shy of 200 million with that 5% fares lower to start the year, as you mentioned, Brad, but really going strong against Boeing and some of the commentary saying, quote, he doesn't have a lot of confidence. He also has not spoken to Boeing's new CEO and has, again, been very outspoken about the delays in 737s in particular, and air traffic control issues as well, which has personally impacted so many of us over the past couple of years as there have been staffing issues on that side of things. So citing some of those broader headwinds as company-related pressures as well there.
Absolutely.
All right, well, we are just minutes away from the opening bell on Wall Street here. We're going to be watching how the trading day kicks off. Stick with us here. You're looking at declines across your screen here. The S&P down 0.3% and the NASDAQ down 0.4% after that tech sell-off that we saw yesterday. We'll see how NVIDIA earnings could change the game for that. That's next.
That's the opening bell. You're watching the Morning Brief brought to you by Invesco. Take a look at the NASDAQ, where you've got the great folks from NBC, ringing the opening bell. Middlefield Bancorp, okay. Oh, wow, you got the IMG Academy. We just had the CEO from IMG Academy on, and they got a new partnership with Merrill. We also had one of the representatives from Merrill. Is that Armando Baycott? Yeah, it is. Former UNC basketball player, also former IMG Academy basketball player there. All right, great bunch of folks on both sides ringing the opening bell this morning.
I love to see it, Brad. Thank you for putting the basketball intel to use for us. We always appreciate it. Just taking a look at what we are seeing across markets at the moment. You're still looking at a pressure here across the NASDAQ intraday. We'll wait for that to load up for a second. But the Russell not having as much pressure as we saw in the pre-market trade, but the Russell was actually the outperformer compared to the NASDAQ and the S&P yesterday as we kind of cement this rotation narrative. And of course, all eyes on the NASDAQ for that big tech rotation and whether or not NVIDIA earnings are going to be able to turn things around for the tech trade. So I know someone who's going to have an answer to that for us. Let's get to Yahoo Finance's Jared Blickery for a look at what's moving markets today. Hey, Jared.
Well, thank you, Maddie. Just wanted to take a quick look at the Dow because we did have the first record closing high, and this is a 9-month chart. I'll just put a year to date, almost the same chart there. First record high we've had in about a month, so nice to see that coming back. NASDAQ, not quite there. And then the S&P 500, well, that just came within inches, actually just a few points of the all-time high. So you might think it's just a matter of time. We'll see. Volatility not looking too disruptive today. That's a 16 handle on the VIX. But I wanted to check out the 10-year T-note yield because that was jumping a little bit. You can see it's up 4 basis points right now to 3.86%. What stands out to me in this chart is that yields, the 10-year T-note yield specifically, has retraced all of its gains for the year. So just a big round trip there as we try to price in some Fed rate cuts. And let's take a look at the sector action. Then I got a couple futures notes for you. Financials, healthcare staples are leading. We had also consumer staples was leading in the pre-market, also consumer discretionary, but not so much the case now. And it looks like tech and real estate are the two laggards. I just wanted to show you real quick the 1-month totals here. This is going to go back trailing months, so it dips into July a little bit. But utilities, real estate, staples, those defensive sectors, those are the outperformers. And let's just take a quick look at the indices. You can see these are global indices. Most of them are positive for the month. And I think that's very striking because we had those 3 down days at the beginning of the month, 2 or 3, and we were tracking the worst August in something like 20 years. So back to the futures market, just want to show you, this is a 1-month view, and this is convenient because coffee is near the top. Coffee perking up once again. You can see breaking to, I don't know if that's a record, but it's very close. And on a 5-year chart, you can see it's just testing, had this huge cup and a tiny little handle there. So if and when coffee futures are able to break out, it's going to take a lot of attention there. And don't tell Sazi because his costs are going up on the morning brew.
All right. Jared, thanks so much as always. And thanks for bringing us not only the moves in commodities, but also, of course, the moves in tech that so much of our audience is looking at this week. We do appreciate it. Thanks so much. Well, we are going to move on here and look at the Magnificent 7 ETF. The shares are down over the last 5 days, with the Mag 7 shedding over $140 billion in market cap on Monday. That dragged the S&P 500 over 0.3% lower to the downside. Now, this ahead of NVIDIA's highly anticipated earnings report out Wednesday after the market close. Here to discuss what's next for the sector, we've got Seema Shah, Principal Asset Management Chief Global Strategist. Seema, it's always great to have you on, so thank you for making the time here. I just want to talk about what we are seeing in terms of this market rotation at the moment. Earlier, I was mentioning that the Russell was sort of the outperformer yesterday. Now today, the Russell taking a bit of the foot off the gas here. Is this rotation that we're seeing right now a healthy one, or is that just the label that folks who come on our show are putting on it to make sure that we maintain some upside momentum here?
Thanks for having me on. So I think what you have been seeing is that in the latest earnings season, that really strong earnings performance that we had seen very much isolated to that big tech group has now started to broaden out to other sectors. That is a reflection of pretty healthy, solid economic growth. So it is. I think it's a healthy improvement in the market. You never really want it to be entirely dependent on a handful of companies, which can always, potentially disappoint. So this is good news. The thing that we need to watch from here, though, is with the economy slowing down somewhat, can you continue to expect to see some of these other sectors which have done well in Q2 to actually continue to deliver good performance through the rest of the year into 2025? And I think the jury is probably still out on that one.
What are those sectors?
So it's anything outside of the big tech, the large consumer discretionaries. So some of the areas that we'd be watching out for at this point is, of course, financials. Some of the companies which do well in a rate cutting environment, such as real estate, utilities. So there's different segments which will be buffeted by the various forces. What we generally want to see, though, for a healthy equity market is that you're seeing performance which is spread out across a number of sectors rather than just being driven, as I said, by the Magnificent Seven or a couple more tech companies.
Sticking with tech, I'm just curious, are lower rates to come from the Fed as big of a catalyst for big tech as they were prior to 2022 when we were in this free money market and you could have the likes of WeWork raking in cash to be able to do whatever they wanted with because cash was free? Are we going to see the same movement in tech moving forward, even though we've had this shift to the idea that tech can still be a driver of returns, even with cash being a little bit more expensive?
Yeah, it's a good question because I think the environment for tech has certainly changed. As you said before, it would be when rates are going down, there would probably be some outperformance. I think things have changed a little bit, sorry, the other way around, but I think that things have changed a little bit where the tech sector is somewhat macro agnostic. What people are investing in tech for is the productivity gains, knowing that it's at the forefront, I guess, of productivity and growth for the economy. So what we would actually expect is that there could be certainly some headwinds as you go through the coming months and growth starts to slow down. But at the same time, these companies are strong enough, are probably the strongest ones, to be able to pivot, rely on their very, very strong balance sheets, the fact that they're very cash rich, they don't come across the same kind of problems that a number of the smaller companies would. So actually, this is more about, can they really deliver on the sky-high earnings that investors have put on them, rather than actually, to my mind, what is going on in the macro backdrop.
Seema, I loved one of your write-ups, and I was upset that it was about the UK economy because I wish that we could say that it was, the US economy and give the US economy some type of kind of cool, viral, sensational kind of annexation to it. You said the UK economy is having a brat summer. And right now, Demure is in focus. I don't know if we want to go there or not, but all of these things considered, how would you define the U.S. economy and even as we're kind of looking across and waiting for consumer confidence to come out at 10 to get a better sense of exactly how consumers really feel right now?
Yeah, I love that term. And I think I've had a couple of people say, actually, that does remind them of the US as well. There is a bit of a difference, though. The UK has really struggled over the couple of quarters. And now it seems like it's having a bit of a resurgence and it's getting through what is increasingly looking like a challenging time almost for the global economy. For the US, it's a little bit different because you have seen that growth has been decelerating since it peaked in the second half of last year. Now, we're not very negative. We're not anticipating recession, for example, but we do think that slowdown is building some momentum. And for consumers in particular, of course, you have to watch that because that is a circuit breaker. If they can retain their strength, then maybe the labor market weakness that we've been seeing come through can actually come to a halt and almost stop there. So the consumer confidence numbers, very important. Watching how consumer discretionaries are doing well. Just the general behavior of making sure that any consumer strains that you're seeing come through in the US economy is really isolated to some of the lower income household rather than being spread out to the medium and higher income households. Those are the key things that we'd be watching.
Seema, at what point does that sort of K-shaped recovery that you're describing become a bigger problem for the Federal Reserve, given that it is a little bit harder to see the challenges of the lower income households in the top line numbers in the data?
Yeah, it's a great question. So typically for the US economy, the medium to higher income households account for about 60 to 70% of consumer spending. So what that means is if those two income groups can continue to spend pretty well, and assuming that the low-income household find they're feeling some strain, but they're not really falling off a cliff, those medium to higher-income households can really carry the US economy. Things start to go wrong when layoffs become more widespread, because whatever happens to the lower-income household from a layoff perspective does eventually spread throughout the economy. So it's not a great situation, of course, to have such a bifurcated economy. But it's really the problems start when that lower income households start to fall into the job layoff cycle, and then it does spread, and then the Fed really does have a problem on their hands.
Seema Shah, Principal Asset Management Chief Global Strategist. Great to see you, Seema. Thanks so much for the time and the insights. Appreciate it. Coming up, everyone, the Fed making it clear the time has come for rate cuts, pushing the debate on Wall Street towards the size of the cut. We'll talk it out with an economist right after the break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Welcome back to Morning Brief, brought to you by Invesco. We heard from Fed Chair Jay Powell last week. The time for interest rate cuts has come. More than 70% of investors are now pricing in a 25 basis point rate cut in September, but the size of that relief still remains an open question. Here to weigh in, we've got Ryan Wang, who is the chief U.S. economist over at HSBC. Ryan, what camp are you in? 25, 50? What would you like to see? What's the real reality?
Thanks so much for having me. Look, I think as we've gotten some more economic news over the past several weeks, I think that 25 basis point rate cut at the September policy meeting is looking more and more likely. Certainly, we did hear very clearly from Fed Chair Jerome Powell that the time to act is basically upon us. I think there's still some question about what the size of that initial move should look like. But given the overall comments on the state of the labor market, yes, labor market conditions are cooling, but we don't necessarily see an elevated rate of layoffs. I think we're more likely to see that more incremental start to the rate cutting cycle with that 25 basis point reduction.
What's going to drive the difference between 25 and 50 cuts at the next meeting?
Well, look, I would answer this in two ways. I think in the back of the minds of FOMC policymakers, they do want to have a sense of where they might be headed before making that decision about pace, right? I think that's really what it comes down to. Timing, how quickly you want to move policy into a stance that might be considered neutral or less restrictive on the overall economy. And you have to be forward-looking in a sense. But at the same time, if we don't really see that loss of business confidence that would be signaled from a spike in layoffs, if instead all we're really seeing is a less frantic pace of hiring, which is how Powell put it, then I think you have a little bit more time to be cautious, to move incrementally. You might still have in mind a destination, but I think there's less urgency to move that way in a very fast fashion.
I mean, we've heard more acknowledgement as well, or at least submission to the idea that it's not wages specifically that are continuing to drive inflation. So what is it? What is the larger, more outsized part of the mix that is still accounting for the most rises in prices that we're seeing?
Well, I think that's right. I think this is why the labor market data have been so important, because they, in a way, have a double implication. Firstly, it's just one half of the Fed's dual mandate. So when they see signs that the unemployment rate is rising, that labor market conditions are less tight, Powell talked about the decline in hiring rates and quits rates below their pre-pandemic levels back in 2018 and 2019. That's something to think about in and of itself. But also, I believe it's changed how the Fed is thinking about the balance of risks with respect to inflation. Now, if you look at the actual current data on inflation, you still do see elevated rates of services inflation. I think it does reflect the kind of what we've seen out of the labor market in the past 2 years, which admittedly has still been pretty tight. But also when you look at what businesses are saying anecdotally, comments about labor shortages are becoming narrower. There are still pockets of labor shortage, but in some cases, these might be structural shortages, particularly in skilled trades, where businesses may not even have an expectation that they're going to be filling their open positions. So when you look at all the data, I would say that it's those signals the Fed is paying the most attention to, and that's why that on the margin, they've become a little bit less focused on upside risks to inflation.
Ryan, what do you think about the slowdown in hiring that we've seen? And more broadly, how linked do you think that is to the talk that we've had throughout 2023, early 2024, that we were heading toward a recession? Did that kind of strategizing from the finance world impact hiring on the labor side of things? And does that read through raise eyebrows for you? I guess I'm just wondering if that was a problem.
Well, I think if you really look at it, 2 years ago, roughly at this time for the economy, was probably the most intense phase of hiring. And it was pretty much also the peak in inflation pressure. So I think part of the uncertainty is that both have cooled down significantly over the past 2 years. But it's hard to say exactly what it means because it was such an unusual period. Businesses were hiring because we were in the midst of course, the unprecedented reopening of the economy following the pandemic. So you can understand why businesses were trying to hire so aggressively and finding that it was difficult, finding actually that voluntary turnover, that's what the quits rate signifies, was limiting the ability of businesses to add to their workforces. Now that's changed because a lot of those positions have been filled, right? And so the question is whether the labor market data are signaling something more worrying. And, understandably, we're always looking forward. So the next step after being comfortable with the current size of your workforce might possibly be a turn to layoffs. And I think in the data and anecdotally, we do not see evidence of that turn occurring just yet. But I think essentially markets are going to be somewhat nervous about this prospect for the rest of this year and into next.
And what would that translate for productivity, especially as we're continuing to monitor more broadly here some of the changes that are taking place in the workforce, larger kind of tectonic shifts even, whether that be technology-based or whether that just be the workforce right now starting to feel a sense of burnout, especially in certain sectors. So how are you tracking what those layoffs would do to the broader kind of trends that we're seeing already start to take place and formulate within the workforce?
Well, that's really interesting how you point to two possible factors that could be supporting what we've admittedly seen as pretty resilient productivity growth over the past 1 to 2 years. Some of it's on the technology side, and of course that gets a lot of focus. But perhaps actually what we're seeing on the productivity side is also workers that are more comfortable in their current positions. Because again, we've just gone through this wave of just enormous turnover, business formation, worker transition. And actually, workers may now be in jobs that they're better suited to be filling, that they prefer because of all this turnover we've seen in recent years. And that may actually be boosting productivity, right? So that's a positive. However, by its nature, that's something that should be temporary or transitory, if you like, in the broadest sense of the word. But right now, I think the U.S. economy is actually benefiting from both sides. A lot of increased labor input, a lot of increased labor supply over the past few years, but also pretty strong productivity growth. And that's maybe part of the reason why even now we're still talking about U.S. GDP growth that, okay, maybe is slowing below the 2% level, but it's not even totally clear. After all, the latest quarterly GDP number was still almost 3%.
Well, Ryan, it sounds to me like you're describing a little bit of the Goldilocks soft landing that Jay Powell is trying to engineer here. At what point can we declare that soft landing, and what is your call for the time horizon on that?
Well, I think I agree with you in the sense that I think there is some evidence in the data that that's potentially the way the economy is headed towards a softer landing. Now, I don't think there's any point, and I think FOMC policymakers would agree, that you can just declare victory. It just simply doesn't work that way. As soon as the economy transitions into a slower growth pace, you're going to be focused on, well, how do I prevent the next challenge, right? And I just think that inevitably, with growth likely to, at some point, to slow below the 2% level, with job gains slowing, with wage growth slowing, that implies slower income growth in the future. So when you look 1 year into the future, there's good reasons to expect that growth would slow further. I think the key really for the Fed is they're trying to figure out how to navigate interest rates to create that balance, right? And it's just this never-ending quest to try to keep the economy on an even keel, even though you can never achieve that perfectly.
Yeah, really great point, and certainly that is the challenge for the Fed and central banks around the world. Ryan, we really appreciate you joining us this morning. That was Ryan Wayne. He is HSBC's chief U.S. economist.
Thanks so much.
Coming up, and this is huge news for those of us at this table, a change could be coming to your Chipotle bowl. We are going to reveal the brand new protein that Chipotle is testing out at a couple locations. We're going to do that with our Stocks in 30 after the break.
Welcome back. Watching the Morning Brief brought to you by Invesco. All right, we're taking a closer look at Yahoo Finance's trending tickers here. You hear the music, you know what time it is. Let's fire up Chipotle, Hershey, and Coca-Cola. Not all at once, might give you a stomachache. We're doing it in 30 seconds each. Let's go. CMG. First one there on your screen. The shares are slightly higher right now. Fast Casual Giant testing out. Drum roll, please. There we go. New Chipotle Honey Chicken at 80 locations in Tennessee and California. The new protein receiving the highest marks of any chicken innovation from Chipotle. Who are the high mark taste testers here for Honey Chipotle Chicken?
Chipotle conducted a study on their own menu.
Right, sounds like we love it.
But I mean, I'm excited to try it. Hot honey chicken.
Hot honey chicken. Everybody's doing it. Diggin is doing it right now, so why not? And we've been teased by Chipotle from time to time on what some of these limited time offers will be. This is the latest.
All right, well, that was a great 30 seconds, Brad. I'm going to kick it off here with Hershey shares in the red after Citi downgrading the chocolate maker to sell. That is down from neutral. The firm saying that volume challenges and cocoa inflation could weigh on earnings to come. And this is such a great look at a company that can be impacted by what we talk about in commodities. I know it can seem boring when you say the word commodities, but when you've got a run up in the price of cocoa like we have seen, that is something that is going to increase costs, not just for consumers, but also for the companies like a Hershey that is having to pay for that cocoa, obviously a key part of their supply chain. And Citi's saying that they anticipate 2026 earnings to be a recovery year after a tough 2025.
You're right. It does sound boring when you say commodities, so that's why we say chocolate.
Yep.
Coca-Cola shares rising slightly here today. Morgan Stanley naming the beverage company as a top pick and raising its price targets to $78, up from $70. There you're taking a look at the shares. They're moving higher right now by about 0.9%. We'll round that off to top pick status, not bad at all here. However, think about the broader environment that Coca-Cola tends to do well in, especially if you do see any type of trade down in the consumers or just looking for more buying in bulk. We were looking at Costco earlier, rising here on the day. Perhaps more people looking at where they can just buy Coca-Cola in bulk. Costco, BJ's Wholesale, some of those other options, even Walmart could be rounded out into that. I think we're at time.
Yeah. Oh, yeah. I think we crushed it. Well, we got 10 seconds. So I will say consumer staples rally when market is getting a little bit scared.
Yeah.
So that could be another reason why we're seeing Coca-Cola to the upside today. That is our show for the day. Coming up, we are going to get a fresh read on the consumer. We got consumer confidence data right at the top of the hour. We will be together to break those numbers for you next on Catalyst. Stick around. Welcome back to Yahoo Finance. I'm Madison Mills alongside Brad Smith. We are 30 minutes into your trading day. Let's get to the three catalysts for the day that we're looking at. Consumer confidence data crossing now. Markets also bracing for Nvidia earnings, and we've got reduced outlooks for oil. We'll get into all three of those.
First up, a fresh read on the U.S. consumer. The data coming in better than expected, indicating that consumers are feeling pretty confident right now. We'll dive into those numbers in just a moment.
And the Magnificent Seven recovering from a 1.2% decline yesterday. That comes ahead of Nvidia's earnings on Wednesday. That will be the biggest catalyst of the week for markets. But could the chip giants' results be enough to bring the rest of the tech sector, which has been under pressure, with it? We'll discuss and get you ready for all of the potential moves.
And Wall Street expectations on the oil market slipping just a little bit as Goldman Sachs and Morgan Stanley both slashing their outlooks on the crude market, citing concerns about a surplus in supply as OPEC Plus is set to increase supply in October. That could mean lower gas prices ahead. We spoke to Path Trading Partners Bob Iacchino about the outlook.
My overall stance on crude oil is that demand fears are just too great at this point. And when you look at what's going on with the Fed and how they're about to start rate cuts, that doesn't necessarily lend to a picture of stronger demand in the short term.
We'll dive deeper into the outlook for crude oil later on in the hour.
But first, we've got that breaking consumer confidence data from the Conference Board for August. The Consumer Confidence Index coming in at 103.3. Economists were anticipating 100.7, so that is a beat significantly to the upside here. Again, that headline number coming in above expectations at 103.3. This comes also above what last month's reading was, which was 101.3. And we've got a revision to the upside as well of 101.9 actually for the prior month. So what is the key takeaway for these numbers? Well, as you can see, the market is recovering a little bit from some of the downward pressure that we were seeing earlier, though it is still in the red. That could be an indication that the market is reading this as good news for the economy. The consumer is feeling better than anticipated about the economic situation and conditions we are seeing right now. That could be an indication that the broader economy is on track for further growth to the upside and that people are feeling good about the inflation's work to tamper down inflation and also keep the labor market under control.
Yeah, we got a comment from Dana Peterson, good friend of the show, chief economist over at the Conference Board, who had mentioned overall consumer confidence rose in August, but remained within the narrow range that has prevailed over the past 2 years here. Adding on, consumers continued to express mixed feelings in August. Compared to July, they were more positive about business conditions, both current and future, and also here, though, a little bit more concerned about the labor market. Consumers' assessments of the current labor situation still positive, though, we should note, but continued to weaken, and assessments of the labor market going forward just a little bit more pessimistic. So all that consider a hotter than expected consumer confidence reading here this morning. Let's broaden this market conversation out just a little bit. We're seeing all three major averages right now slipping about 30 minutes into trading. Now, on the back of this stronger than expected consumer confidence report, we did see just a little bit more movement here, but this is largely where we've been at over the course of the start of today's trading activity. Markets have recovered from that early August slump. Yeah, you remember that. My goodness, Mercury went into retrograde and the markets reacted. And the S&P 500 trading near highs, the Dow closing at an all-time high on Monday. So is there more room to run in this rally, in this rebound that we've seen, or should investors seek less risky opportunities? We've got Troy Gajewski, who is the Chief Market Strategist over at FS Investments. Troy, always a pleasure to speak with you and get some insights here. So do you believe that there is more room to this rally?
Yeah, I think in the ultra short term, we're continuing a recovery phase from the recent correction, which was driven by obviously tremendous yen strength and a deleveraging across markets. However, we're going into a pretty ugly seasonal period historically in September. And, valuations are a terrible indicator of short-term performance, but they tend to be a pretty good indicator of medium to long-term performance. And we were through yesterday, it's open 21.5 times forward earnings, which is more expensive than we came into 2022 before the Fed started to tighten. So, for our clients, we're really focused on what we refer to as growth at a reasonable price, kind of an almost archaic concept for public listed equity markets these days in middle market private equity, particularly focused on the secondary market where there's a lot of selling pressure still from institutions. You can pick up pretty good discounts. And then if you're trying to get income, there's still tremendous opportunities in private credit, because even though the Fed is about to cut, the new terminal rate is 3, the current base rate's 5.25, and you're still earning a healthy spread to risk-free with delevered balance sheets and tremendous opportunity in asset-based lending.
Troy, just to circle back on the Fed of it all that you mentioned here, the level of cuts that the market is pricing in right now feels commensurate with a economic downturn, right? And I'm curious, can you have your cake and eat it too? Can you anticipate 100 basis points of cuts before the end of this year and also be pricing in an equity market that's going to continue to hit new all-time highs?
Yeah, so we have been coming into this year, we were in the 2 to 3 cut camp. We're now at 3. We'll more than likely get 325 basis points cut. So the market's priced in a little bit more than will probably take place. That being said, if you think of this entire Fed hiking and cutting cycle, this is one of the few times where markets are relatively aligned with reality. Remember, coming into the year, there was the prospect of 6 cuts, which was laughable. And then when we got stronger inflation data in Q2, it was like the Fed's not going to cut at all. That was laughable. Your point is accurate, though. It's tough for the Fed to thread the needle. But remember, we're in a period now where, business fixed investment is cranking, construction spending still going strong. The consumer is not in the robust shape they were a year ago, but is still in a relatively good place. And so our expectation is for the Fed to guide or cut by 3 times next year, somewhere between 3 and 6. That should help support consumption and keep us out of a recession. However, if the Fed ends up cutting more aggressively, that basically lays out the scenario you're discussing, where we are going to enter an unexpected recession. And at that point, clearly equities will go through a meaningful dislocation. Think somewhere around 22-ish type price action or slightly worse. But that is certainly not our base case.
Troy, if NVIDIA comes out and lays an egg in their earnings report this week, does that become more important, and what they say become more important than what the Fed has already signaled?
Yeah, it's a great question. So, obviously the bar was super high for NVIDIA going into the last several earnings. This earnings season, not quite as high. There's a lot more trepidation on AI spends going forward. Obviously, NVIDIA hasn't recaptured its recent high. So from our perspective, on a technical basis, if they miss, there's less downside than, say, the last few quarters. And if they really beat again, there's more upside. Furthermore, if you parse through the data and look at the AI spends, which I don't think people recognize just how large these business fixed investment spends are for mega cap tech. They're literally 70 basis points of a $28.6 trillion nominal GDP in the US now. Really big numbers. If you look at the spending, really the mega scalers in the cloud, have decided it's better to spend too much and overspend than underspend and get left behind. And so naturally, the beneficiary of that are semiconductor companies, which continue to have forward demand growth and free cash flow margins at market caps the like we've never really seen in the history of public listed markets. So to short answer to your question, if they miss, less downside than the prior 2 quarters, and if they beat, arguably more upside, not only there to that individual company, but to the broader tech sector.
Is NVIDIA unsellable right now, Troy?
I think saying unsellable gets back to what your personal positioning is in terms of your portfolio. Obviously, one would be foolish to expect the same degree of market cap growth that we've seen in the last 18 months. But if you think of where you go for growth in markets, right, there's really 3 choices right now. There's middle market private equity right in the middle of the risk reward. There's venture capital, but those are very long cycles and obviously super volatile, and you have to lock up your money for a really long time. And then there's mega cap tech in the US or publicly traded market cap weighted indices. The problem there is not the fundamentals. The fundamentals are solid. It's the valuation. So you have to recognize that given the elevated valuations, you're going to have less upside. But it's going to be very hard for any active manager to sell down further after a lot of that exposure had been reduced the last 2 to 6 weeks, not only in the long-only community, but also in the hedge fund community. So it would probably be unwise if you're a long-only active manager to sell down NVIDIA right now.
Troy, I can tell you're really fired up about middle market private equity. Why is that, and what is the entry point for investors that even want to kick the tires on middle market private equity?
Yeah, so there's still constraints, regulatory constraints. In some cases, you have to be an accredited investor. In some cases, qualified client. If you're doing any type of drawdown structure, you still have to be a qualified purchaser. However, the industry's democratized those strategies. It's really the last frontier of democratization of alternatives, bringing private equity through evergreen RIC structures. So there are limitations. However, the reason we're so fired up is if you look at PE historically, the way middle market's driven return is through organic growth, through growth at a reasonable price, where you haven't necessarily needed a zero interest rate policy environment to lever up the balance sheet. You've benefited from, but you haven't needed the multiple expansion we got from 2009 through even today. So with the expectation of a stronger for longer economic environment, a higher for longer interest rate environment, growing EBITDA at 15% plus is a reasonable expectation. And this whole concept of growth at a reasonable price, it's very hard to find across markets. You can find growth at either unreasonable prices or at least extremely expensive prices. You can find goofy value and other cyclical exposures, but it's really hard to find growth at a reasonable price. And then on top of that, you have this tremendous secondary opportunity because institutions got over-allocated to private equity and still are, and in some cases are choosing to sell down those exposures at significant discounts. So that kind of creates a near-term performance pop, which provides new investors a good entry point to first participate in the asset class.
Yeah, entry points are ever more attractive in the high valuation market we're in right now, Troy. Thank you so much for joining us.
Great
really
to see
appreciate
you.
your time as always. That was Troy Gajewski, Chief Market Strategist over at FS Investments. Now, NVIDIA earnings, the event to watch this week for investors. Coming up Wednesday after the bell, analysts do have lofty expectations for the chip giant, expecting earnings growth of over 100% year over year, and revenue growth much more modest, about 99% year on year. NVIDIA heading into its results with 66 buy ratings on the street and shares up over 150% this year. Here's what we've heard from experts on the show over the last few weeks.
I think we're in a bear market in NVIDIA, and I would not be a buyer.
All eyes will once again be on NVIDIA as kind of the bellwether of this Magnificent Seven and this AI trade. Any weakness, any softness? Maybe the entire Mag 7 rotation out may pick up a little bit of steam.
Being one of the best positioned semiconductor company, obviously levered to one of the strongest product cycles in AI right now, we think it's still attractively valued at these levels.
And Brad, I think it's really interesting when you talk about the run-up NVIDIA has had over the course of this year and the earnings expectations that continue to be so lofty. As I mentioned, that 99% growth year over year when it comes to the revenue side of things. Will a beat be enough for the street to carry this name to the upside? Some of our guests have said yes, others have said the bar is just too high. And we're already seeing earnings expectations kind of quelling a little bit as we head into Q3. So next quarter could be a lower bar, but we still got to get through tomorrow.
Yeah, I'm just looking at the move, the expected move based on some options AI data here. And we're looking like an implied move potentially coming out of earnings of about 9 to 10%. Now, that is kind of absolute value. So you could see this potentially based on options contracts out there rise post earnings if they are able to deliver this Goldilocks report. Oh, yeah, and signal that there's even more demand that's going to be coming NVIDIA's way as it looks to further entrench its market share, even where you've got some of the competitors that are and got out in front of NVIDIA saying exactly how they were going to tap into the generative AI demand and be able to bring some of that on over to their side of the ship. All these things considered, it's about a 9 to 10% move that we could potentially see post earnings, and it's still going to come back to exactly what Jensen Huang says on this earning call. If he says that not only is demand strong, but China is not an issue, and also they have pricing power, then we could see this rip to even more than that 10% based on what we're seeing in the options market right now.
Yeah, I think it's a really great point, Brad, to bring up the degree of movement that the market is anticipating here. And as you mentioned, the percentage-based move, that could be up to $300 billion, which is more than the size of a McDonald's or a Cisco just in the course of one trading day after these earnings, according to the options market. So really big day for NVIDIA here.
I mean, you got me hungry with the McDonald's references here. I'd usually be having a McGriddle right about now. All right, anyway, coming up, we got a break, so maybe I'll just sprint off and grab one. Coming up, taking a look at some trending tickers on Yahoo Finance, including the S&P 500's biggest laggard from Monday, Supermicro Computer. That is after the break. We're taking a look at some trending tickers on Yahoo Finance, starting with Supermicro Computer shares falling after Hindenburg Research discloses it's shorting the stock. This comes as the stock is up over 90% this year on AI hype. Shares right now are down by about 3.7%. Here are the few of the bullet points coming from this research report here. 3-month investigation included interviews with former and senior employees, industry experts, as well as a review of litigation records, international corporate and customs records. They found glaring accounting red flags, is what they're saying, and also evidence of undisclosed related party transactions, sanctions, export control failures, and customer issues. And it takes a lot to disclose some of the, not just research that went into this, but also the short position that you're executing as a result of this research, as many of the firms stopped publishing that post GameStop and the Reddit retail trading frenzy that we had seen back in 2021. Some of them had paused that, but Hindenburg saying, we're confident with what we saw to start this and execute this short position.
That's a really great point, Brad, not only because of the tie-in of the retail investor activity impacting some of the institutional investment and that read through there, but also because taking on a short of a semiconductor name has its own set of risks, particularly the day ahead of NVIDIA earnings. This is likely going to cause a bit of pain here, but SMCI shares were down as much as 8% pre-market off of this news. Now they're down about 3.5%. Just taking a look at some of the initial analyst reaction that we are getting in from one of the industry analysts over at BI, saying that the short position and the report here does not have that much new information to it, so it's not necessarily going to be a long-term catalyst for downside movement in SMCI. However, it could put the spotlight back on SMCI for some of this activity, including things like client relationships, especially in light of kind of heightened U.S. scrutiny of AI system sales to some of these sanctioned companies and countries, which we have seen through the Biden administration is likely to continue in upcoming administrations, whether that is the Trump or Harris administration as well. So this is a story that could continue to cause some pain for SMCI moving forward here. All right, let's get to another trending ticker. We are looking at shares of Marathon Digital under pressure after a JP Morgan analyst lowered their price target for the stock to $12 from $14. And you can see, I didn't think that the downgrade from JPM was that big of a deal here, but I was impressed by the stock move that it caused. This is a company that is down nearly 5% here as we are about a half hour into the trading day. And this is a company that has been under pressure. This comes up in the Yahoo Finance trending tickers quite a bit. It's a company that our audience tends to like to monitor here. The analyst updating Bitcoin miner models to reflect the second quarter results and recent changes in the price of Bitcoin and the network hash rate. That is what JPM is citing as the reason behind this move today.
Yeah, no, you're spot on. I mean, as we're continuing to watch Bitcoin sit above, and we just had it there on the screen a hot second ago, sitting above $61,000, just shy of $62,000 here. It does come back to what the profitability on a mining basis does look like, especially post that halvening that had already taken place and was the big event that many of us were trying to keep tabs on because of how much more costly, basically double the cost for mining activities out there if you're getting half of the rewards. So all of these things considered, Marathon Digital continuing to plow through, but it's largely coming back to what we're seeing in the price action for Bitcoin as well in that profitability spectrum.
Really good point too. The picks and shovels kind of moving together in that space here. All right, let's get to our final trending ticker here, and that is Pfizer, the latest pharmaceutical giant to break into the telehealth market following the lead of its rival Eli Lilly, which launched a similar plan back in January. Here with the latest on this, we've got our very own Anjali Kamlani. Anjali, what do we need to know?
Yeah, so basically you've got these two pharma companies saying we want to remove the hurdles for access to their drugs, especially some of the easier stuff. For Pfizer, they're launching a new platform to help patients get access to COVID vaccines, RSV vaccines, as well as migraine meds. And that's an important one because that is where the two, Lilly and Pfizer, are going to be competing. Now, what's interesting about this is that they're not hosting anything on their own. Pfizer is launching in partnership with a number of existing partners. So they are going to basically link up with ZocDoc. It's a popular appointment booking platform. Meanwhile, they're also using the retail pharmacies, CVS and Walgreens, in order to get access to the drugs. The direct part of it comes where they're trying to help remove the hurdle. So for migraine patients in particular, it can take some time to get an appointment and then get access to the drugs. Same is true when you're in need of, say, Paxlovid for COVID or getting to those vaccines in time. So they're doing a lot to help create an easier access pathway. Lilly as well is doing this. Now, the sort of immediate thought process is, well, they're cutting out PBMs and they're cutting out sort of these middlemen in the health ecosystem. But both companies have told Yahoo Finance that that is not, in fact, the goal. And if you do look at the way that they're set up, they aren't, in fact, not cutting out those individuals that make up the broader health ecosystem, but instead are really looking at ways to enhance access to them. One key difference as well is that Pfizer is partnering in addition with Instacart and Amazon to get those delivery, those products delivered faster. And that includes stuff that is not Pfizer products. So that's, a COVID-19 test, an at-home test, or over-the-counter medicines as well. So it seems like they are trying to add to what has become an out-of-pocket ecosystem in some ways, right? With costs kind of hitting patients' pockets for these telehealth visits and the like. So some of them are, and this is why it's so convoluted. I'm so sorry that I couldn't break it out any easier. But the telehealth platforms themselves are not all covered by insurance. So some of those are out of pocket and some of those will be covered. So it's a very mixed bag picture in terms of what is and isn't covered and what patients will have access to.
It's extremely mixed bag. I mean, I was reading this at my desk earlier before we came on the show, and I had about as many facial reactions as Kombucha Girl sitting here trying to figure out what the so what of this is. I mean, for investors trying to figure out how much of the D2C element is really going to bring consumers specifically into engagement with Pfizer, and what this does in terms of rattling some of the relationships that Pfizer already has. Like, what is the largest priority of this?
So what I find interesting about this is that they aren't measuring this as a profit maker, right? Both companies have explicitly said.
So why do it?
Well, they are looking for brand recognition in a time and a place where we know that patients want more trust, right? You're thinking about it. It could be a brand booster for them. In addition, we've seen success with this kind of platform, GoodRx, for example, right? One of the companies that already offers this kind of pathway to medicines. You click in, you text, you say, this is what I think my problem is, and a doctor will just prescribe you something. And so this is similarly the way that it's going. And both companies have said that this is not a way to specifically boost their own products, but we know, of course, it will, because that is a pathway that they're coming in. Another little interesting tidbit, Pfizer is going to be using targeted ads on social media. I don't know that Lilly is. So this is, I know you have more questions. Go.
No, it's okay. It's okay. Our producers are telling me we're running short on time.
It is fascinating, though. I know.
It is.
It is, and I think that was a really good way to kind of wrap up the investor angle of this, that potentially it leads to brand awareness. Maybe that leads to more market share. Maybe that shows up in earnings several years down the line, even if it's not today. And also, of course, it's complicated. It's healthcare. If it was easy, then there wouldn't be policy debates about it for the last century or so.
Correct.
So really appreciate you breaking it down for us, Anj, and thanks for joining us on that. Coming up here, investors losing patience with tech firms when it comes to AI growth. We're going to talk to a software analyst next about that ahead of Salesforce earnings on Wednesday. Stick with us.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Investors' patience for AI growth seems to be wearing thin, according to our next guest. While NVIDIA is expected to see massive revenue and earnings growth as companies spend big on AI infrastructure, investors are hard-pressed to find returns on these investments. So, who is best positioned in the space? To help us answer that question, we've got Rishi Jaluria, a good friend of the show. He is the Managing Director of Software Equity Research at RBC Capital Markets. That's his official title, friend of the show, just a side title. Rishi, great to see you here. All right, so of the companies that we've seen aggressively spending and communicating to investors that there's a bigger risk of underinvesting in AI, who is best positioned to see the largest return on that investment in the near term?
Yeah, absolutely. And thanks so much for having me. Look, I'm glad you framed the question that way because near term, it is going to be really tricky. I would completely agree. It's better to overinvest and underinvest in generative AI because this is truly a generational technological shift and technological unlock. But I do think investors have to have patience. And if I were to say, who is really going to monetize generative AI in a big way over the next 12 months? It's a very short list. In my covered universe, it's literally Microsoft. Beyond that, I have a lot of companies that I think I like from an AI standpoint. I would say HubSpot, I would say MongoDB. However, those are more 2 to 3 year stories and beyond, rather than something where we can see direct AI monetization in the next year. But there will be a lot of investment required, even if you're not a company like Microsoft or Amazon that has to spend a lot of money on physical hardware. It requires a lot of product development, re-architecting, and then the actual use of LLMs themselves is really expensive.
What does Microsoft need to do to convince Wall Street of the argument you just made, Rishi? Because the shares were under pressure in the 48-hour period after their earnings due to questions about the ROI on their AI spend.
Yeah, I think there's really 3 things that they need to do. Number one is they talked about still being capacity constrained when it comes to AI. Over the next several quarters and really the back half of their FY25, they need to show us that acceleration, that what can AI growth look like in that Azure line once they don't have capacity constraints, once they have enough data centers, once they have enough GPUs, et cetera. Number 2 is I think we need to see other software companies develop their own AI modules. We see hints of this right now, but a lot of the revenue that Microsoft is seeing on the AI side is by using the OpenAI APIs. And so when we see companies like HubSpot or even Salesforce or ServiceNow or Workday developing their own generative AI systems using OpenAI, and we start to see usage of that, that flows through to Microsoft. And then the last is we need to see actual usage and adoption of AI in Microsoft's portfolio outside of the Azure line. So really Office Copilot is the big one we're looking at. It's still very early, but I think over the next year, if we can start to see real usage and adoption of that Office Copilot SKU, that can really help the narrative for Microsoft.
Rishi, I remember using, like just sitting in, listening to AI Day for a company like Salesforce. I was really excited, and there's so much that we're going to see within Copilots in the B2B landscape. Where does Salesforce and what we're set to hear from them when they report earnings, what do they need to say to really signal to the street that there's the opportunity for them to add on to how they're selling in to their existing client base with this new technology?
Yeah, Salesforce is a really interesting one because by all logic, it should be a major beneficiary of generative AI because they have data, they have distribution, they have a giant customer base. It should be easy to cross-sell. What I've been kind of seeing out of Salesforce, quite candidly, is a little bit disappointing on the AI front. And this is kind of backed up by talking to customers and partners as well, is they really want to see more out of Salesforce when it comes to AI. So to get to the question of what can Salesforce do, I think it's going to require a lot more than talking on the earnings call. It's really going to require, they have their user conference Dreamforce next month and right out here in San Francisco. I think they need to show us real innovation around AI, that they are actually investing aggressively to be AI first, to treat AI not just as a feature that you're adding on, but really fundamentally changing the way that salespeople work. Because that's really what the cloud did, right? That's what Salesforce did. Salesforce changed the way salespeople sold to their prospects and to their customers. And I think generative AI is going to do the same thing. And Salesforce needs to show that level of innovation. And I'm hopeful that when we're all talking after Dreamforce, we start to see some signs of that.
Rishi, we saw last quarter Salesforce had the biggest one-day decline since, I think, early 2004 off of their earnings due to some of the points that you just mentioned here. And you can see there on your screen, the stock's been under pressure over the past 3 months. If we get tough results from Salesforce again this time around, could that put pressure on the overall AI trade that's been driving the market narrative for so long?
You know, I do worry about the results for Salesforce, which they'll be reporting Wednesday, because there is potential kind of based on mixed checks out there for growth rates to come down further. Recall, this used to be a consistent 20% plus grower. Now we're talking about it in double digits. And if it actually drops below double digits, you'll have a narrative shift. However, I think the good news for the entire AI trade is it doesn't feel to me like Salesforce is one of those names that investors are looking at as a hands down AI beneficiary in the way that they are looking at companies like, you know, Microsoft or NVIDIA or Meta. And so I don't think weak results out of Salesforce would necessarily unwind the AI trade. However, weak results out of Salesforce would make people worried about the macro environment in software, and maybe it continues to be really soft out there.
All right, Rishi Jaluria, Managing Director of Software Equity Research at RBC Capital Markets. Thank you so much for joining us and getting us prepped for those Salesforce earnings. We appreciate it. Let's turn now to today's chart of the day here. We know that the labor market extremely important to the Federal Reserve. That's why we've got all eyes on that September 6th jobs report. But the labor market also a critical driver of your portfolio. According to the Macro Institute, it is the most important driver of company earnings. And as you can see here, the year-over-year change in the average weekly overtime hours worked is directly linked to the S&P 500's forward EPS. So you can see this purple line, that's the S&P's forward EPS, and the blue is the average weekly overtime hours in the manufacturing sector. And you can see it's just about kind of that Venn diagram that turns into a circle here, right? S&P 500 company forward earnings directly tied to those average weekly hours. And this makes a lot of sense. The companies that are able to keep up their balance sheets and have strong earnings moving forward, those are also the same companies that are able to spend a little bit more money on their labor force. Maybe they're in the process of growing, and that's why it's specific to the overtime hours worked, that increasing as companies are experiencing more forward demand. Now, what's really interesting about the moment in time that we are currently in, will this dynamic start to change ever so slightly? Because we are nearing the end of our earnings cycle so far this quarter. It's looking like not only it was a good quarter in terms of earnings, but it was more broad-based. That's why we're seeing this rotation narrative get some buzz on Wall Street here. But we're seeing some cracks in the labor market. Just a little bit of softness, a little bit of companies practicing attrition, for example, slowing down on hiring. So if we do start to see a bifurcation in a chart like this, that could spell bad news for the Fed, and it could also mean bad news to come for the S&P 500 earnings cycle moving forward into Q3. So definitely a chart like this, something you want to keep in mind when you're looking at your investments heading into the second half of this year. Now coming up, Wall Street souring on oil. Goldman Sachs and Morgan Stanley both warning that OPEC Plus will be a risk for oil markets. We're going to explain why on the other side of this break.
Treasury yields are pushing higher today ahead of the latest read on the Fed's preferred inflation gauge this Friday, the PCE, Personal Consumption Expenditures data, and just days after Chair Jerome Powell signaled to investors that a rate cut will be coming at their September meeting. For more, we welcome in Kevin Flanagan, Wisdom Tree head of fixed income. So, I think that's the only natural place to start. What type of investment thesis now prevails around fixed income now that you have the Fed saying we're going to be initiating our rate cutting cycle?
It's a great point. I think what's important to take away from Powell's speech on Friday is that money in motion in a new rate regime, that we're starting this rate cut cycle, it looks like in September, at a place that Fed funds hasn't been in more than 20 years. So you have a whole generation of investors who've never experienced rate cuts at these level of interest rates. And I think that plays a big role in determining how you should be making your decisions for fixed income investments.
And when you talk about those decisions and some of the market action that we're seeing today, for example, that upside movement in yields, should investors be approaching those moves as buying opportunities, given that we are anticipating rate cuts to come, which could pressure yields?
Well, I think it was interesting. The chart of the week that you showed before was spot on. And in terms of the Fed's focus now is the labor market. It's kind of like inflation got just pushed aside, right? And now the focus is going to be on the employment part of their dual mandate. And looking at jobless claims, one of the 10 leading indicators, shows that, while the labor markets may be cooling, they're not falling off a cliff. So where I'm looking at interest rates, yield levels, and fixed income and certain parts of the curve, it seems to be a little bit overdone right here, that perhaps the market is ahead of itself and that the numbers won't validate an aggressive rate cutting cycle by the Fed. Yeah, the Fed will cut rates, but maybe it's a quarter, not 50 or 75 basis points at a clip.
Well, let's talk about that then, because the Fed has not been clear about the exact path forward for rate cuts or the neutral rate for that matter. Can we get clarity on that from the action that we're seeing in treasuries?
Not yet. I think actually, the Fed was data dependent in terms of getting to this point, that, the time has come. It was very dramatic from the chairman to adjust policy. And now the data dependence is the magnitude. What is this easing cycle going to look like? And I think the employment report that you outlined for next Friday is going to go a long way in determining how the Fed responds. Is it 25? Is it 50 at this stage of the game? Right now, if you look at probabilities, it leans more towards 25. If you look at consensus forecasts for the August jobs report, it would tend to lean towards 25 as well. So much as if the Fed's data dependent, Treasury market's data dependent.
And then just largely here, as we kind of scale out and look more internationally, is there one outlier when you think of the central banks that are at different points in their own policy decision making, one outlier perhaps that could have impact on the U.S. fixed income market?
It's a great question. I think we saw it a couple of weeks ago. The Bank of Japan. The Bank of Japan put their toes in the tightening pool of monetary policy, and you saw what happened with the yen carry trade kind of getting reversed. And the Bank of Japan seemingly stepped back and said, okay, maybe that's enough. Maybe we should not move too quickly down that path. So yeah, that can definitely have an impact as well, what we're seeing from the Bank of Japan. But based upon their recent comments, you would seemingly, I think, come to the conclusion that they're going to take it slow in terms of tightening monetary policy, where the rest of the developed world is really easing or on the verge of easing monetary policy.
All right, Kevin, thanks so much for joining us. Really great points on the data to come. It seems like that PCE print coming up on Friday, just inflation, it's in the rearview mirror at this point. We're focused on that labor market. Kevin, thanks so much. Kevin Flanagan, Wisdom Tree's head of fixed income strategy. Well, Goldman Sachs and Morgan Stanley both lowering their oil price forecasts as the two banks say they expect a surplus in the crude oil market. This comes as OPEC Plus is set to increase production come October. Now, as geopolitical tensions bubble up across the world, what does this tell us about the reaction function of OPEC and the impact that could have on oil prices moving forward? Our very own Inez Ferre joins us with more. Hey, Inez.
Hey, Madison. Yeah, and Goldman Sachs analysts lowered their forecast for Brent by $5 to a range of $70 to $85. It also lowered its 2025 forecast for oil to an average of $77 for Brent. Now, the reason being a lot of this has to do with increased supply, and a lot of that coming from oil allowance or OPEC plus. Now, the analysts at Goldman Sachs said we still assume that 8 OPEC plus countries, which previously announced the 2.2 million barrels per day of extra voluntary cuts, start to gradually unwind these cuts in October of 2024. The analysts also writing in their note that if OPEC decides to go ahead with the production increases, the market is potentially shifting from a short-run equilibrium to a more long-run and likely optimal strategy where it's basically disciplining non-OPEC supply supports. You also have Morgan Stanley, which has lowered its target for Brent crude as well for the fourth quarter of 2024 to $80 and the fourth quarter of 2025 to $75. Previously, it was at $76. You have what's going on now is the market expectation that OPEC Plus will start unwinding those voluntary cuts. That's going to add supply into the market, and that will weaken the market. And OPEC is really between a rock and a hard place because it wants to keep those prices elevated. But if it doesn't start to unwind its cuts, its members will start to lose more and more share. The U.S. is at peak production levels. Drilling technologies are very advanced right now, and the big oil companies are expecting demand to go forward. So they will keep producing. If that happens, then these other countries from OPEC will start to lose market share, guys.
All right, Inez, really great breakdown of those calls from Morgan Stanley and Goldman, and of course, the broader space when it comes to OPEC Plus and the oil market. Thank you so much. Thank you. We're going to have all of your markets action ahead right here on Yahoo Finance, so stay tuned for more. You're watching Catalysts. We've got 3 top trending stories we're going to break down to close out our show today. Kicking it off with Meta. CEO Mark Zuckerberg admitting to being pressured by the Biden administration to censor COVID-19 content in 2021. Now, this is in a letter sent on Monday to the House Judiciary Committee. This is first reported by the Wall Street Journal. Now, in that letter, Zuckerberg said, quote, "The Biden administration repeatedly pressured our teams for months to censor certain COVID-19 content, including humor and satire. Zuckerberg says he regrets not being more outspoken about it and that he's ready to push back if it were to happen again. I think it's really important for us to note that this is according to Mark Zuckerberg. So we do not know the degree of evidence to which it is true that the Biden administration was pressuring Meta and Mark Zuckerberg in particular for this. Now, this comes after Biden said in July of 2021 in a social media post that platforms were killing people with misinformation around the pandemic. Biden did later walk back those comments, but this was a big push from the Biden administration. I remember speaking with Surgeon General Vivek Murthy at the time, and he spoke openly about the kind of push to make sure that, given that we were trying to get so many people vaccinated, they really wanted social media platforms to be careful with information surrounding COVID-19.
I think something that is becoming even more of a thread is that we've seen Zuckerberg kind of pander to one political side of the aisle when it does benefit him and Facebook, to play them against the other political side of the aisle. And for what you just mentioned, it was humor and satire that I think the administration, based on what Zuckerberg is claiming here and what he wrote in this letter to House Judiciary Committee Chairman Jim Jordan, touching on a series of controversies, as Wall Street Journal have reported about it, he was essentially saying that the Biden administration was telling them or pressuring them to pull down humor and satire posts that were surrounding a global pandemic that actually was still ongoing at the time as well. And so there is, I still think, a responsibility for some of the social media platforms to recognize the harm that they could cause, even more so if there is misinformation or disinformation attempts that are emanating within their platform. And so, it's a larger question of what role Zuckerberg wants to have in acknowledging that as well at the same time, or if they just want more clicks, more traffic, and if the information is out there for people to just view it themselves and decide what to do, which is still something people can decide to do on a regular basis.
And the role of Congress, right? There shouldn't be this much question marks around this. If you have legislation in place, then it's not as hard for executives as well.
Yeah. All right, let's talk about this one. NFL owners are planning to vote later today on a plan to allow private equity firms to buy a stake in football teams. According to reports, 32 professional teams are looking to create a similar group of approved buyers here. Now, if approved, private equity firms would not be allowed to have full ownership control over a team, but rather a percentage of the team, according to reports. The average NFL team is worth close to $6 billion here. Now, I think that percentage is so key because it means that you probably wouldn't have some type of activist campaign say, hey, I don't like how you're general managing the team, or I don't like how you're coaching the team. So they wouldn't have that type of say into football operations. However, what you could expect from this going forward is look at the areas where more teams are trying to identify investment opportunities, even outside of the football operations. This sets up a direct pool of funds for them to be able to use in anything from real estate investments that they may make around the entire fan experience, and providing more value to the team that way outside of what's taking place on the field as well. Could even be technological plays as well that we see some of those dollars used for.
Yeah, really great point, and it'll definitely be interesting to monitor moving forward here. But we've got a special guest with us for our third story here, our very own Brooke.
Just been chilling there the whole time?
I've just been, may or may not been hanging out.
So, Brooke, I mean, this is a really fun story that we're going to kick it off, or end our show with, rather. What do you got for us?
Yeah, so we're talking about the price gap between fast casual and fast food, which seems to have shrunk here as consumers sought out the best bang for their buck. That boosted same-store sales for fast casual chains like Wingstop, Cava, and Chipotle, as well as Sweetgreen in Q2. Taco Bell also saw sales growth after its premium chicken cantina offering boosted sales, and that's a far different story from fast food players. KFC, Pizza Hut, Papa John's, and McDonald's. Other players in the space that saw same-store sales decline include Starbucks. And what it really comes down to, guys, is this concept of value these days. What exactly is value? Is it experience? Is it just price? Is it all them together? And what we've seen is consumers go to fast casual chains, both Cava and Sweetgreen CEO weighing in on this, that the price gap has shrunk and that's benefiting them.
We gotta go. One word answer. Do you think Chipotle's hot honey chicken is going to save and
I'm
reverse
excited
the trend.
about it.
Yeah.
I mean, we've seen in the past chicken al pastor and barbacoa do really well for Chipotle. So innovation seems to be a key trend that bodes well for them.
That was more than one word, but you are the only person that gets an exception here, Brooke. Thank you so much for taking the time here. That's Yahoo Finance's own Brooke DePalma. Hey guys, coming up on Wealth, dedicated to all your personal finance needs, of course. I'll have you for the next hour, and we're going to be talking about, well, a little bit of everything. Stay tuned. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks to grow your money. Hey, on today's show, Wall Street is expecting a rate cut in September. We'll talk about what it means for your money and how you can set up your portfolio for success. And U.S. home prices hit a record high in June. We'll break down the data and reveal the most affordable metros that you can call home. Plus, billions of dollars of health savings or flexible spending accounts out there go unused every year. But loyalty program Built has found a way, for you to use those dollars. I'll be joined by the CEO of Built at 11:20 a.m. Eastern Time. All that and much more on today's show. But first, the Fed's path forward here. The central bank is expected to lower interest rates in September as inflation moderates and the job market sees signs of cooling. So, how should you be positioning your portfolio ahead of rate cuts? Here to weigh in studio, we've got Tom Hayes. He is the Great Hill Capital Chairman and Managing Member here. Great to have you here with us in studio. So first and foremost, what type of pivot should investors be positioning for, especially going into this first potential cut here come September, as we're all expecting?
Well, I think, Brad, we've got some seasonality factors at play. In an election year since 1955, we generally have pretty good strength into early September, into mid-September. And then as we get closer to the election, we get a little volatility, late September, October. That happens to coincide with the first cut mid-September. And historically, the first 2-3 weeks after the first cut tends to be a little bit weaker. So you have the headwinds. So I think you dance while the music's playing right now. I think we're going to get probably some new highs we saw in the Dow yesterday. We'll see what happens with NVIDIA tomorrow. Maybe the S&P and the NASDAQ will catch up a little bit. And then I think as you look at all those profits and you're smiling so wide, you could eat a banana sideways. In early September, you say, wait a second, cuts come in, election volatility's coming, and maybe harvest a few profits, have a little cash on the sidelines late October, deploy into year-end rally.
You know, it's really interesting because I hesitate to ever cast any doubt on NVIDIA, especially in this day and age and in this market right now and in the performance that they've exhibited. Yeah. But those NVIDIA earnings are going to be out Wednesday. That report itself, if it is a dud, then what does that signal for the back half of this year?
Well, initially, because of the weight, 6%, 7%, depending on the index, initially you'll get some weakness. But what we have seen since we got some clarity that the Fed's going to be cutting is a regime change that started in July, was temporarily impaired by the yen carry trade unwind for a minute until BOJ relented and say, wait, we'll wait to raise rates until the Fed actually starts cutting so we don't get the liquidity mismatch. So I think the focus is the shift is going to be from large caps to small caps. Large caps underperform small caps in the first 12 months after a cut by 11%. So small caps outperform by 11%. And that's also consistent with earnings growth. So this year, small caps are expected to grow earnings at 7%. Next year, 37%. And Mag 7 earnings growth decelerates from 30% this year down to 18% next year. So if NVIDIA does less well than people think, I think you're going to start to see a lot of the stocks under the surface start to pick up the slack. So even if Mag 7 underperforms, you can make a tremendous amount of money under the surface.
Just to put a fine point on this as well here, I mean, the information technology sector, and according to some data from FactSet, information technology is reporting the second highest year-over-year earnings growth rate of all 11 sectors at 18.9% right now. And NVIDIA is the largest contributor to year-over-year growth right now. So for investors trying to figure out whether or not, even given the run-up that we've seen in NVIDIA, this is still a ripe investment opportunity, what would you say to them?
Okay, it's nuanced. I think the earnings are going to be okay tomorrow. The reason is we saw all the hyperscalers were spending like crazy. That's why their margins are going down. The magnificent margins are going down. Earnings growth is going down because they're giving all the money to NVIDIA. I think there's going to come a time where investors say, where's the return on our investment? That's 2 quarters out. But right now, NVIDIA's priced for perfection. $3.2 trillion valuation. Our entire GDP is $28 trillion. So you're saying it's worth 11% of our total GDP? Like, trees don't grow to the sky. It can grow a little higher, but you have to keep in mind 28 times sales is pretty rich, 37 times earnings is pretty rich. Yes, you'd say the earnings growth is 38% long-term growth, but then you look at the numbers and it just doesn't make sense because rule of 72, is it really going to double every 2 years? Sure. That would imply it's going to be half a GDP before we know it. It doesn't make a lot of sense.
All right, while we have you here, just lastly, because there are a lot of people who are trying to figure this one out, and you have some thoughts on it as well. Boeing has a windy road of challenges that we've seen over the course of this year. The stock is down, 33% year to date. I think we have a chart we can toss up for the viewers at home. Do you see this as a buying opportunity?
I think it's phenomenal. Kelly Ortberg came from Rockwell Collins. When he got involved with Rockwell Collins, it was a $7 billion company. 6 years later, he sold it for $30 billion, 4.5 bagger. This guy knows how to run business. The second second thing is he's actually an engineer. So for the first time in a while, we get to have Boeing run by an actual engineer versus a salesman, which is helpful when you want to keep doors on planes and keep things, fuselages together and all that stuff that's important. But the key thing is it operates in a duopoly. Okay, so at the end of the day, you can say, I don't like Boeing. They've been sloppy the last few years. Okay, well, get online at Airbus and you can wait 20 years for your next plane. They've got 6,000 plus backlog. They just said, oh, by the way, we underestimated the demand because China's flying is picking up. The middle class is growing. They're going to need another 8,000 planes. So what you like to see with stocks that have relentless, everyday bad news is that they stop going down. And that's happened to Boeing in the last few weeks. Headlines have been bad every single day and the stock stopped going down.
NASA saying that they're going to use SpaceX.
It couldn't get any worse. Like you couldn't make this stuff up. Every single day they screw something up and the stock has stopped going down, which tells you that most of the problems are in the rearview mirror. Kelly Ortberg is going to turn around this ship. The duopoly is in place. The backlog of over a decade is in place. So we like this as a high quality business that's temporarily impaired.
Yeah, I should just clarify as well for those who are viewing as well, and the full story on the NASA's astronauts. They used Boeing and the Starliner to get them up there to the ISS, and now we're trying to get them back, and they're going to SpaceX for that. Anyway, all these things considered, still a Boeing story. Tom, you're still great. Great Hill Capital Chairman and Managing Member Tom Hayes. Great to see you.
Thanks so much. Appreciate it.
Turning now to the housing market. U.S. home prices started the summer at a record high, but the pace of price increases moderated in June. For more on the numbers, let's bring in Yahoo Finance's Danny Romero from the newsroom. Hey, Danny.
Brad, homebuyers can't catch a break. Home prices hit a new all-time high in June, but home price growth is slowing. The S&P Case-Shiller National Home Price Index rose 0.2% in June on a monthly basis and marked the 5th consecutive monthly gains. Now, on an annual basis, the national measure rose 5.4%, but that's lower than the 5.9% increase we saw in May. Remember, this is a lagging indicator. June's Case-Shiller index tracked a 3-month average that started in April when mortgage rates were hovering around that 7%. Separately, the index that tracks home prices in 20 of the largest cities gained 0.4% on a monthly basis. New York continues to be an expensive city among the 20 largest metros in the U.S. Annual home price gains reached 9% there. San Diego, Las Vegas followed with gains of over 8%. Now, this could be due to the supply and demand dynamics in those areas. Still, affordability remains a challenge here. Mortgage rates are now moving lower, helping with affordability, but buyers and sellers are in this wait-and-see mode. Redfin reported this morning that over 85% of homeowners nationwide have a mortgage below 6%. This could mean that a majority of sellers and buyers are waiting for mortgage rates to drop even further, as the Federal Reserve has signaled a rate cut next month. Now, bottom line, housing strategists at Morgan Stanley believe that lower mortgage rates will help with affordability, boost sales activity, and lead to a slowdown in home price growth. Brad?
Danny, appreciate the update there. Thanks so much. Yahoo Finance's Danny Romero there. Guys, coming up, with rate cuts expected from the Federal Reserve in the upcoming months, how should you be setting up your portfolio? We'll discuss when we return. In about a month, we'll enter the final quarter of 2024. My goodness, where's it going? But there is still plenty of news to come before the new year. You've got rate cuts to the November election, all of which could affect your pocketbook and your wallet. So how can you set yourself up for success for 2025 and beyond that? Here to help, we've got Michelle Martin. She is the president of Prosperity, which is an Eisner-Amper company. Thank you so much for taking the time here with us today. So, of the major events to come, of course, we've been tracking towards the rate cut and ultimately, finally now getting a little bit more color on that being in September versus us just guessing when it would happen. So now, what does that do for people who are trying to figure out what their pocketbook, what their wallet is going to look like, what their investment strategies are? Is there a pivot that they should be initiating?
Absolutely, Brad. Great to see you this morning. Thanks for having me on. People are thinking about portfolios now for a couple of reasons. Number one, as we talk about with the pending election, there's always questions around that. But more importantly, I think, is just what you mentioned, which is the Federal Reserve anticipated rate cuts in September and then likely again even in December. So, the whole idea here is to slow growth. They've been slowing growth, and now we're at a point where with interest rates starting to come down, people are going to start seeing some changes. One of them is the nice rates that we've seen in money markets and savings accounts. So short-term rates are going to start shifting downward a little bit. So one of the things to think about is to invest and extend those investments in, say, those savings or money markets that you've been sitting nicely on the sidelines with, doing what we call extending duration, putting that in investments that are a bit longer term, so you can lock in those interest rates.
Now, as we mentioned at the top as well, the rate cuts, just one huge event that's set to kick off. The general election is just over 2 months away. Should investors be setting up their portfolio any differently ahead of that event?
Brad, I really don't believe that it's a game changer. One of the things I think that when you're thinking about your portfolio, it's really easy to get caught up in the elections and wondering what policy things are going to affect your portfolio. But at the end of the day, sticking tried and true to your plan, thinking about your overall allocation. Maybe right now, typically before elections, there's a little bit of uncertainty. Stocks are priced for perfection right now. So if you're overweight and feeling like you have too much risk in your portfolio, there is a potential where you could trim back some stock exposure. I would do that in your IRAs because it's not a taxable event. But there's definitely some things that will come up. I think just being aware of the fact of how much risk you're comfortable taking and where you're at. Also, where you're at in your life planning is really important. If you're an early investor and you have a really long time horizon, by all means, it really shouldn't affect much of what you're thinking about. If you are someone nearing retirement and you've been riding the market and feel like perhaps it's time to scale back on risk, it might be time to take stock. Actually sit down with your advisor, put together a financial plan, take stock of your spending and what your forecast looks like as it relates to projected cash flow and meeting some of your retirement goals or any other short-term goals that you may have.
Michelle, we only have about 30 seconds left, but 2025, is there a major event that investors would be right to get ahead of, as we know that the expiry of the Tax Cuts and Jobs Act is not until the end of the year. So how can one best position ahead of that event?
Right, Brad. So a lot of individuals, one of the big things that's going to change is the estate tax exemptions. The Tax Cuts and Jobs Act will essentially just expire. So most advisors, many estate planning attorneys assume that it will just end at the end of 2025. You should be talking to your estate planning attorney, your advisors now. People will be working through this in 2025, but it's going to be a very major event. There'll be a lot of people reviewing their estate plans, their financial plans, I would start earlier rather than waiting until later, because a lot of these decisions are very thoughtful. They take time, and it's better to have the luxury of time to make those important decisions for your family.
Michelle Martin, president of Prosperity and Eisner Amper Company, thank you so much for taking the time here with us today.
Thanks.
Certainly. Coming up, everyone, we're speaking to Built Rewards founder and CEO on how you could get more bang from your buck from flexible spending and health savings accounts. That's right after the break. If you don't use the cash pile you put into flexible accounts, you lose it. Over half of the 3.2 million flexible spending accounts forfeit funds due to non-use. And the average amount of money wasted is $441 per person, according to the Employee Benefit Research Institute. But a new partnership might help you use all of your HSA and FSA funds with ease. Built teaming up with Walgreens so that you can load your FSAs and your HSAs to your account and then have it automatically pay for eligible items. Doesn't end there. You can rack up some Built points. All right, so for more on this, let's just bring in the man himself, Ankur Jain, who is the founder of Built, here with us.
Good to see you.
Great to have you here. We've also got our own Anjali Kemlani. Anj, great to have you here for the discussion. All right, so let's start on the partnership first, because this is a new element. You've got some other partnerships, which we'll get to later on, but Walgreens here, what made this make sense for them?
So let's start with, when we started the business, we said cost of living is rising in this country faster than income, faster than wages, and that's a huge problem. I mean, you're seeing it's the top focus of the election conversation right now. When we started Built as the neighborhood loyalty program, we said, how do we reward people for housing? And created the first program that lets you earn points on rent, right? But healthcare is also a huge expense for Americans and is only growing. And so we said, look, when you go to your neighborhood pharmacy and you're buying these everyday items, how can we help you save money in an easier way, just like we did for rent, right? And what we realized was so many items, but not just prescriptions. I mean, sunscreen, toothpaste, cough drops. There are countless items that are eligible for this savings program where you can save up to 40% on everyday healthcare products. But it is so hard to use the FSA, HSA today that over $4 billion were being lost every single year. And so with this new program, you can now walk into a neighborhood Walgreens. As a Built member, you can spend with any American Express, any Visa, any MasterCard, just like you normally would. You get your Built points, but now we can automatically identify any of the items that are eligible for the savings, and with one click, apply those for you, so you don't have to worry about it anymore.
How does this differ from, I mean, I understand the automatic points being a big part of it, because right now you could easily just identify them, pay for it separately, et cetera, right? It's a very—
you say easily.
It's a multi-step process. Easy in the sense that, you can at least, you do have an online way of doing it, but—
If you're in store, you don't. You're often going in, you're having to check out, then you have to ask after the fact, then you have to go back to the counter, return it, change the transaction, pay for it with your FSA card. I mean,
this is something people often don't know as part of the program. And so when you're applying these automatic deductions, talk to me about why Walgreens first, and what potential you have to expand beyond, because not everyone shops at Walgreens.
So this is really exciting. I mean, we call this the automatic healthcare savings benefit. It's part of being a Built member, again, in your neighborhood. When you look at neighborhood pharmacies, I mean, Walgreens has national presence in all of our neighborhoods where we provide this neighborhood loyalty program. And of course, we're continuing to now scale that out with all the exciting local pharmacies as well, right? But there is such an opportunity to help people save, by the way, not just on everyday healthcare costs at your local pharmacy, but we envision this type of program being able to help you save automatically on your doctor visits, maybe at your grocery store. I mean, people don't realize you can use FSA, HSA benefits even at the grocery store on a ton of items. And so I just keep thinking, the first step to fixing some of these healthcare costs is take the billions and billions of dollars that are sitting there unused for Americans and make it easy for them to access it, right? You shouldn't have to study a textbook and read up on what's eligible and what all these things mean just to save some money on everyday healthcare costs, right?
And to be fair, e-shopping is a lot easier because the companies do identify the eligible items. And then to your point, that's interesting about getting into the doctor space. I'm curious about that because I wonder if you have thought about also like the telehealth platforms and the like. Talk to me about where it's applicable.
There's so much that you can do with this, right? And I think that's the key. And by the way, it's not just healthcare. We talk about housing, we're talking about healthcare. There are these government programs, or these private programs for people to save money on everyday expenses across the board. FSA, HSA is one of them. You see the same thing, by the way, on student loans. I mean, the amount of student loans that are not covered today that you could have access to different deductions or credits for is also a complicated area, so we'd like to look at that. Groceries, same thing. There's a lot of these credits out there for healthy eating that are very hard to tap into today. So if we can just remove friction, create value, and also have the benefit of rewarding you with points and miles along the way, I think that's a win for consumers across the country. And that is really how we're thinking about category by category.
As you mentioned, it's not just this category in healthcare. You also had a partnership with Wells Fargo. That's set to end in 2029 unless there's some critical renegotiations taking place. Are you in talks with Wells Fargo to renegotiate the terms for that card?
I wish anybody would talk to me about renegotiations 5 years in advance. Unfortunately, we haven't even had those discussions yet. It's so far out in the product and such a new product in market. But we've got partnerships across housing, across dining, across healthcare. And again, our focus is how do you reward consumers in their neighborhood on their largest expenses? And so we work with the merchants, we work with real estate owners, we work with major banks. You mentioned Wells Fargo, we work with Bank of America, we work with American Express, we work with Visa, we work with MasterCard. So really our idea is, again, however it is that you go about your everyday life, when you're paying your rent, you should now build your credit. We're the largest credit reporter on rent payments, by the way, in the country, helping people build their credit by paying their rent on time every month. We're the only program that actually rewards you with airline miles and hotel points for paying your rent. And now we are automatically helping people save on these everyday healthcare costs. And we're going to see this continued expansion over the next few months as we think about what about people who pay their mortgage?
Yeah.
People who live in condo buildings. We recently launched with Douglas Elliman so that people who pay their condo fees also access these neighborhood benefits, right? We're looking at how can we help people on other transportation. Today we have a partnership with Lyft where when you take rideshare across the neighborhood, you're getting these additional rewards points for every ride, every day your commute to and from work as well. So how do we continue to scale that? And so again, think of your biggest expense in life is housing.
Right.
But 80% of your discretionary spend outside of housing happens within 15 miles of your home, right? And that is the neighborhood ecosystem that Built is creating here. You have your airline loyalty program, you've got your hotel loyalty program. Everybody should have a neighborhood loyalty program.
Ankur Jain, who is the Built Rewards founder and CEO, plus our very own Anjali Khemlani as well. We got to continue this conversation, check back in the future as well here. But we got to end things there for today. Coming up on the other side of the break, Yahoo Finance markets reporter Jared Blickery talking seasonality, volatility, small caps, all that and much more with chief market strategist Ryan Dietrich. That's on an episode of Stocks in Translation. Stay tuned.
Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. And today I'm joined by my sidekick, Sydney Freed, and Ryan Dietrich, making a special trip to New York, I think, hailing from Ohio. The Sultan of Seasonality, Bold Boss Ryan Dietrich is here from the Carson Group, Chief Market Strategist there. And welcome, guys. Today we're going to be talking about, guess what, the global risk roller coaster that we all seem to be riding on. And our phrase of the day is seasonality, of course, perfect for you, Ryan. And this episode brought to you by the number 86. That is the percent time the Russell 2000 index is positive 1 year following a 5-day 10% thrust, the likes of which we just saw. And we'll get into all those wonky details in a second. But Sid, Ryan, let me get, Ryan, your thoughts on the big picture market. We've had this terrible upset in the risk markets with the Japanese yen going nuts. What do you make of this?
First off, thanks for having me, guys.
Yes.
This is going to be fun. I'm looking forward to this. Flew in this morning, and I'm here nice and smooth. It's raining in your city, though. It kind of messes things up.
No, you get a 74-degree day.
It's true. It's not hot.
That's actually a celebrate.
I was here 2 months ago. I was melting. But nonetheless, you think about this year. I mean, it's an election year. Yes, we had the best start to any election year since 1976, middle of the year. Then here comes August. We get into the seasonality part of it. August sometimes gets these rare events. We've only, going to air quotes here, only had about 8.5%, mild correction so far. Now, most years see more than 5% pullbacks a year. You see a 10% on average. I mean, our take, we get into the details of this, we still do not see a recession. We still think it's a bull market. The headlines are scary, absolutely. But you know what? Most years have scary headlines and some scary pullbacks, and we're still optimistic that once we get through this rough patch, which could be sooner than later, we'll still have some pretty good gains left, Jared.
You have been remarkably consistent in your call for no recession since last year. That was when it started not to come. And we want to get to our word of the day here, seasonality, because that kind of plays into our discussion. Seasonality refers to the predictable and recurring changes in data that happen at the same period every year. So, we can take, we were just talking before the show, we got S&P 500 data back to 1928, before the S&P 500 existed, so to speak. Wrap your head around that. But nevertheless, you can parse the data any number of ways, but sometimes there are some clear trends. And tell me how you use seasonality in your work.
Yeah, we would never blindly just invest in seasonality, but I'll tell you, it is really amazing when you look at some of these seasonal trends. Listen, let's talk about August for a second here.
Yes.
August, historically, when August is down, it tends to really be down, like more than any other month. In 1990, Iraq invades Kuwait. 97, the Asian contagion. 98, Russian default led to the long-term capital management implosion.
2007, quant meltdown.
2011, we had the
debt downgrade.
The debt downgrade. 2015, the Chinese yuan devaluation, and here we are now with another currency around the globe. And listen, is it random? Is it not? I don't know. But the reality is light volume. People are away in August. You get these big news events, and looking back, all those months we just mentioned were very big down months across the board, no question.
People say crash and they think October, but August is a real killer too.
When it's down, it really is. That is exactly right. And obviously we've had one of the worst starts to an August ever, kind of bouncing back a little bit. But I think that's one way to look at it, that you get these little clues with seasonality. Just this year, coming into this year, all right, the last 10 times you had a president up for re-election. Now, I know where you're going to next question where we're going with this, but when the president up for re-election, market's been higher the last 10 times, right? Market's doing just fine, and then we got some drama out of Washington. You could say that's kind of in the soup, so to speak, and kind of why we're having potentially a little volatility. But I think, to answer your question, I think it's all about the end. I know people think the economy's slow, and we get into that. It is parts of it. The Fed behind the 8 ball, yeah, I agree. I think they are, but let's not forget we rallied last Wednesday when the Fed did its thing. I think the market was okay, knowing there's more cuts coming. The reality is the yen is the Japanese BOJ really upset the apple cart with that hike that apparently nobody expected, and then here we go.
Well, so backing up a little bit, is it that August can be a little wonky? From my perspective, just because it's, we're almost most of the way through the year. We're kind of closing in on the start of the third quarter shortly. Is there an event that precipitates something like this, or is it just that it's the end of summer and people start doing weird things?
Yeah, I think, a little combination of all those, really. I think a lot of it does. Volume's usually light. You look at, what were we just dealing with before all this started? I know it was in July, but or June. Let's talk about June just for a second here. The worst day in June, remember what it was? Down 0.41%, 41 basis points on the S&P. The worst day all of June, okay? And a good chunk of July was like watching paint dry as well. So you kind of can have that, and then boom, what we've seen throughout history, when periods get slow, there's volatility, then you get a lot of volatility, things get slow. So I think with that low volume, people, just on our team, a lot of people are on vacation the last week or two. It's like, oh my, I think a lot of people, I heard Jerome Powell's on vacation this week. Maybe he's working from home, working remotely.
Jackson Hole coming a little early.
Jackson Hole's coming a little early, you better believe it. So anyway, I just think it's kind of all those things together, really.
Okay.
It's just good to know, I think. It's a good context to know.
Yeah, and then following on that, what do you typically see in an election year?
Sure.
Yeah. Well, again, it's two-sided, if you will. Election years on average up about 7%. But when you historically you've had a president up for re-election, and again, I'm aware of what's happening right now, you tend to get a strong second half of the year. It's those lame duck years, 1960, 2000, 2008. Now, there's some big things happened in 2000 and 2008 that kind of skew those numbers. But that's just something to be aware of. And that's something we've been talking about a lot. And then you also look at elections. What do markets hate? Uncertainty, as most listeners probably know. And then you tend to get, what you really tend to get in most election years is this: a sell-off ahead of the election. Okay, just the last two elections. What do we see? 2016, 2020. Good weakness ahead of it. Then the uncertainties, over, once that election's over, then you get that upward bias. And I mean, we said a month ago, if we would have done this, I'd say, we'd be foolish to think we're only going to have 1 5% correction all year. That's what we had earlier this year. Ahead of an election, you're probably going to have more volatility. And I know this volatility, again, is because of what's going on probably with the BOJ. Nonetheless, that's what you tend to see. So we could have, I think we can talk about the VIX volatility. There's a lot of cool stuff going on there. But I think we're trying to carve out a low, but doesn't mean the low is in play. And just know September in an election year is not all that great. So I wouldn't be shocked at all if we had more scary headlines with that election around the corner.
Let's talk about the data for a second. Data is actually not that bad. And we had a slightly disappointing payrolls report last week. You can knock off you can blame part of that on the weather, but also I'm looking at defaults, credit card defaults. Those are running the right way. Those are going down. And so I'm just wondering, you haven't seen recession. Talk to me about the data, maybe the potential for an upswing here. Maybe that's the issue.
Well, that's our case, right? We don't think there's a recession. You mentioned defaults are going down. Look at how many people are getting laid off, right? Layoffs are not spiking at all. I mean, usually you see layoffs spiking if there's a recession around the corner.
Jobless claims pretty muted.
Jobless claims, well, we had a little bit of a spike, but again, a lot of that potentially was what we just saw in Texas, right? I mean, Texas had a huge spike in initial jobless claims because of the storm. So we're watching that, but again, a lot of the consumer data, there's some cracks, yes, but again, it's not over the top. I mean, you think about market peaks, it's usually at excesses, right? I mean, yes, credit card debt, quote unquote, an all-time high over $1 trillion, but so is net wealth. Net wealth is up exponentially even more. So we call this denominator blindness. Yeah, numerator's up, but denominator, net wealth, if you own a house, you own a house with some stocks last 10 years, you're probably worth a lot more. And then the other big thing we hear all the time is, well, inflation's up a lot and it's really hurting. And there's no question inflation's up a lot. Since before COVID, the core PCE is up about 19%. That's the
20% is not nothing.
Well, it's not nothing, but then you look at wages, you look at compensation up 25 and 26% on the whole. And you know whose wages are up even more? The lower 50%. So I'm not saying things are perfect out there, but there are some real positive, Jared, when we look at it, that we say this is overblown. One more comment, we all freaked out. We all, not me, but a lot of people freaked out last week. I don't know. Right? Everyone freaked out when we had that manufacturing data last week from 300 purchasing managers that said they're not hiring, and everyone got all worked up about it. And then the jobs data came in a little wonky. Also, again, I think we're that you can say there's probably some weird things going on with the weather in Texas last week, or last month. But in reality, services number just came in yesterday.
Yes,
and services is really strong. Employment, new orders, business activity, that makes up a huge part of the economy versus the 10 or 11% from manufacturing. Not ignoring manufacturing, but it's like let's take the full picture here.
Talk to us a little bit about the moves we're seeing in the VIX this week.
Yeah, bite down on that.
Yeah, because that massive swing up.
Let me get a drink. Oh boy, yeah.
Massive swing up. I'm seeing right now down 6.5%, although I'm told that is the wrong way to say it. So can you also explain a bit about that?
Well, sure. So I mean, it's like a joke, I guess we use on social media.
Some people on X take it very seriously.
They do.
I took it seriously when I saw your tweet.
Well, so you can look at the VIX should be looked at in terms of points. So I did it move 5 points, 10 points, because when it's low like it was recently, you can have a very big percentage move, and it's not really telling the same story. Like, the VIX is up 100%. I mean, that's a big move. But again, from 10 to 20 is not the same as from 20 to 60 when you talk about volatility. Now, to get to the VIX, this is the last 3 days, previous 3 days. First time in history, going back to at least 1990, we had a VIX close beneath 30, go above 60 intraday the next day, and close beneath 30 that third day. That's never happened before.
If you watch it, you just have to laugh when you see that, because it's just ridiculous.
It really is. So
is it even useful anymore?
Well, that's a good question there. We haven't even had a 10% correction, and we got a VIX over 60, one of the highest levels you've ever seen. Now, here's again on the points basis. Yesterday, the VIX closed down 10%. That's on a closing basis, closed down 10%. That's a huge drop, an implosion of volatility. What's that tell us? Well, historically, that's really rare. All right, I'm talking like after the flash crash, after U.S. debt downgrade in March of 2020. The last 3 times we've seen a 10-point drop in one day. 1 year later, higher every time after that, and lows were pretty much formed and up over 27% on average. Not saying it's going to happen again, but when volatility implodes, It's kind of the market's way of saying we're trying to carve out that low. And it is fascinating. At the time we're doing this, VIX is 23. You know, if you just took off last week, you would have never had any imagine. If y'all look at the VIX where it was, 23, oh, nothing happened. Well, not so much.
Mr. Seasonality, plying your trade on the VIX. I love it. VIX seasonality. All right, we need to take a short break here. Coming up, we're going to take a look at small caps looking for some sunshine. And we're also going to talk more about the VIX, which could shed a few pounds. We stir things up with a volatile Who Wore It Better? Up next. We are back and our sponsor is calling. It is the number 86. We recently had the Russell 2000, that's a small cap index, surge 5 straight days, up over 10%. And this was before the nasty sell-off we had this week. So a little context there. Ryan, you recently calculated what the Russell 2000 looks like a month later, 3 months, 6 months, 12 months, when it has that big 10% move in 5 days. It's up 86% of the time. That's our number right there. With a median gain of 19%, the average is 27%, pretty high. Not quite as bullish on the shorter time frames, only 57% positive a month out, but I think that would be welcome news for people who are staring at the short-term technicals in the Russell, which is not looking great right now. We had that break to the upside, and we're back in this 3-year range. It just doesn't look good.
No, it's kind of like Lucy and Charlie Brown on the football, right?
Yeah, that's what it feels like.
The football back, and we've had an overweight to small and mid caps for the majority of this year. Now, mid caps have done a lot better than small, but nonetheless, focusing on small, our big thesis has been inflation is last year's problem. There's going to be some Fed cuts coming, and again, we didn't see a recession. And we saw that huge spike after CPI, a few weeks ago. Sure. Came in better than expected, and that's what sparked that big 5-day, we call it a buying thrust. And again, historically, those buying thrusts are kind of, they show a change in trend or maybe an acceleration of the trend if the trend is already bullish. And the bottom line, again, is it tends to be bullish. I mean, small caps really are historically cheap relative to large. There's, if you look at earnings growth, this earnings season, so, it's okay, and some of the large tech and AI have been a little disappointing, but small cap earnings have been solid. You look out next year, small cap earnings are expected to grow more than large caps, and we think that's very possible, again, with an economy that probably avoids a recession. So there are some drivers there, and I get it. It's kind of a dirty word to say small caps because it frustrated people. Let's not forget the Russell 2 gained 27 or 20, either 24 or 27%. I forget the exact number, but close enough for government work. The last 2 months last year, that was the third best 2-month rally ever. I looked at the 10 largest 2-month rallies ever. A year later, you're talking up close to 30% on average, higher like 8 out of 10. My take, small caps had a huge end of year rally, went sideways for 6 months. Now potentially they're starting to get going again, and I'm aware of the the rug pull that we just saw, but I mean,
I'm starting to believe here. I appreciate this.
Yeah.
Does it matter if small caps are the leader or not?
Oh, good question.
Yeah, it really, listen, I mean, I guess it depends how your portfolio is. If you're all in large caps, you wouldn't like that. But we think, to answer your question, yes, we like to see other groups participating versus just those big 7 names, just technology, just communication services. And to see that, like I know, Jared, you look at this stuff all the time, those equal weights, right? The equal weights are finally starting again to do well because, again, we know the large names in the tech haven't done quite as well. So to see some participation across the board, we like. Now, I mentioned we like small. We also like financials and industrials. You know, on Sunday night when we were promised to crash by a lot of people, you know, as of the middle of this week on Wednesday, the industrials and financials actually up on the week. You know, I mean, that's kind of amazing when you look at that. And that's that leadership that we're looking for. We like the cyclical names, small and mid.
All right, so let's talk about that. You mentioned financials, industrials, healthcare also reaching new highs, all-time highs this year, at least in the large cap space. Talk about some of these other groups, because for a long time, this talk was just Magnificent Seven, Mag 7, concentration worries, and then we had the appearance, and this goes back to that small cap breadth for us that we were talking about. Looked like things were rotating, kind of got kneecapped by the yen, but talk about some of these other sectors that are participating.
No, there really are. I mean, look at year to date. 10 out of 11 sectors are positive on the year.
And financials have led at
they've led a good chunk of that.
Wait, so does this just mean you should own all the sectors?
Well, I think well, let's put it this way. So I get to work with financial advisors all around the country and talk to their clients. What clients love to do is chase a shiny object. Oh, tech's the best thing? Let me have some tech. Oh, that's the worst, like utilities, they're terrible. That's the utilities, like one of the best groups this year. That's the worst thing, don't put me in there. So I think we say, you know, avoid the shiny object. Continue to keep a diversified portfolio. Continue to rebalance. Just because something underloved now or loved now doesn't mean it's going to be there in 12 months. So that's kind of how we look at that. But it's a great point because, again, unfortunately, I've worked with clients for 25 years, and that's what they like to do throughout history, and sometimes they can't help themselves, and they make the worst decision at the worst possible time. That's why having a financial advisor sometimes goes a long way.
Sometimes the shiny object can make you a lot of money, though. So, I mean, sometimes that's the right bet, especially in the early innings. I think the problem comes when people just kind of glom on late in the stage. But what are your feelings on the AI trade and the hype cycle? We're in a lull right now. Do you think it reaccelerates?
Yeah, we were on neutral at best technology here. And you look at earnings, though, Mag 7's up 30% this recent quarter. So there's still a lot of earnings growth coming in there. But again, I think it simply got ahead of itself. Just a little too much excitement, a little bit, the world is going to change. And there are major changes coming. I'm not minimizing them. But you see what Google and some of the companies have said. Maybe they haven't. I mean, it's still impressive what's going on, but they didn't quite hit that incredibly high bar. It's just a lot easier to clear the bars a little lower, and the bar got awfully high for those groups. But the bottom line, again, last I checked, tech is still the largest component of the S&P 500. So you can't have that just blindly falling apart. Expect the market to hold up. But they just kind of go market neutral here. And again, that baton gets past some of those cyclical areas and other areas that can lead. That is perfectly normal, and we think it's going to happen and quite healthy.
Ryan, since I've been a participant in markets, I feel like tech has been the leader. Yeah. And Mag 7, everyone's pouring all this money in. If you're a younger investor, I don't know what kind of advice, it kind of seems like you should just pour a lot of money into tech. If you're retiring 30 years out, wait to see what happens. It doesn't seem as comfortable to go into one of those other sectors like healthcare or utilities and say all my money or most of my money is going to go there. So what do you say to that?
No, great point. I mean, let's not forget in 22, we had a vicious bear market. A lot of those Mag 7 and tech names are cut in half, down almost 70% in some cases.
I mean, 2/3 in the case of Meta.
I think Facebook was down, I believe, over 70%, pretty close there. But I think the bottom line for younger people, the advice that I have when I get to travel and talk to people is stick with your plan, right? If you truly want to invest in technology, there's going to be periods. There are going to be years where they don't do so well. And the worst thing you can do is call uncle and get out and then again go chase something else. And again, that's why still being diversified makes sense. But absolutely, if someone's younger and they're going to invest for the next 25 years, they could have geeky words like tilts and things like that. They can tilt their technology a good deal, but just stick with it because, again, there's going to be times, like in late 22, you're not going to feel so good having those Mag 7 names.
That makes sense.
All right, it is time for Who Wore It Better, and let me get the script. Oh, Yeah, I believe this is the debut of the VIX on our Who Wore It Better segment. So indeed, the VIX has been on the move as we've been discussing, recently spiking to 65, the third highest level ever. Sometimes these panics, as seen through the VIX, they're short-lived. Sometimes they persist. So today we want you, Ryan Dietrich, to tell us which market environment is wearing the volatility spike better. So going back in time to the beginning of the VIX in 1990, is it 98 when Russia was defaulting, sending U.S. bond markets in a tizzy, and the VIX to 46, 2008 when Lehman Brothers was blowing up, sending the VIX north of 80, maybe the flash crash just 2 years later in 2010, the VIX hit 40. This S&P 500 or S&P downgrading Uncle Sam's debt in 2011, that was a year later, VIX 48. The mother of them all was recent, March 16th, 2020, when the VIX spiked to an eye-watering 82.69, and we didn't even include Volmageddon because it didn't quite get up to 40.
Right.
But which of these VIX spiking events do you think the market environment is wearing better? And it has some predictive information about where we are now.
Yeah, I think the late 90s. I think 98.
Okay.
You know, there's some similarities there because that started with the Age of Contagion in 97. Now, the VIX spiked in 97, and we've got some the Asian things going on. Let's not forget, August of 2015 was, again, China devalued the yuan. That was the first 1,000-point drop ever in a Dow. Now, believe me, 1,000 points then is not the same as 1,000 points now, but that was a pretty darn scary time too. But I think the late 90s makes sense. And why is that? That's the volatility part of it. But you have to focus on other things. We are seeing, Jared, one of our good big themes. I'm glad I got a chance to remember to even mention this. Productivity. We've been saying for well over a year now, we thought productivity was going to go a lot higher. Josh Schaefer, the cool chart book he does, we shared that early in the year about expecting better productivity. Well, we saw that last quarter. We've seen better productivity for the last year and a half, almost 2 years now in our country. What in the world does that mean? Well, it's been a long time since we've had that, okay? The mid to late 90s was the last time we saw strong productivity. What does that mean? Well, Greenspan told us way back then, you can cut interest rates, you can pay higher wages, but you don't have to worry about a massive spike in inflation. We saw that in the mid 90s. We see some similarities right now. We think the Fed's going to cut. Why is everybody worried the Fed's going to cut? Maybe you see a spike back in inflation. And trust me, it could happen, but with the stronger productivity, we're comfortable saying that's not the case. And I see some similarities right there.
I have a VIX-related question because we've been talking so much about it. I feel like I've never focused on it more.
I've been talking about it in the last 3 years.
This is a great day for Sydney right here.
Who is the VIX for? Like, who should be trading options? Like, I don't really understand who should be dealing with the VIX.
Well, the simplest way to put it, the VIX is a guess on volatility the next 30 days out. So it's for shorter traders. I mean, it is for shorter term traders. Honest to goodness, a lot of smart people I know 2 days ago when we had that big VIX spike were selling volatility. They were selling iron condors and selling puts and selling things like that without getting too geeky on this. When the VIX is low, you could say, okay, well, there could be a spike higher, but we just went 18 months without a 2% drop in one day. A lot of people expected more volatility. Now it's here, no question. But I think it's just important for your average investor when they hear the VIX, they hear someone on TV like myself or somebody talking about it. When you see that spike above 30 or 40, the VIX is a mean reverting instrument. It kind of like oil. Look at oil. Oil's like been flat. The price of gas has been flat for almost 15 years. You think about it. But the VIX is that way too. It spikes, but then it can come much lower, and that's kind of how it works. That's the average person should think of it like that.
On that, we sort of have been talking a little bit about advice for early investors. What is one piece of advice you wish you could have told yourself when you kind of started dealing with the markets?
Yeah, great question there. So I started late 90s. All right, so I was caught up in that bubble. And I lost a lot of money. I made some money on the way up and then lost, but I learned, okay, bubbles happen and you get all caught up. So just always kind of remember a lot of smart people, I wasn't that smart when I was younger, but a lot of smart people can get caught up in a bubble. So if that kind of, Sir Isaac Newton, okay, he lost as you know what in the South Sea bubble, right?
He made a lot of money on the way up, and then he rebought at the top and rolled it all the way down.
We're going back to Isaac Newton right now.
The point, fun, playful way, but the point is that one of the smartest people to ever live could get caught up in a bubble because his neighbors were getting rich, everyone's getting rich, and he wanted to get rich or put more money in, and then I believe he died very poor, I believe.
And bitter.
And bitter. So anyway, if that could happen to him, it could happen to a lot of people, right? It could happen to anybody. So I think it's just important to remember that. But the other thing for young people, you're going to blink and you're older. It happens fast. Time really is on your side. Can start to put as much as you humanly possibly can in 401ks and Roths and IRAs, all that stuff, because you're going to your future self will thank the young self who wants to take that money and go see the Olympics, but you might thank yourself a lot more down the road.
15 seconds. Any final words for investors?
I just think we've gotten through this before.
Yeah.
We've had scary times before. Investors need to remember that we're going to get through this again. One final thing, earnings are still strong. I mean, earnings are still strong. Corporate America, I know AI was a little weak, tech a little weak, but other groups, look what 3M said, okay? People are still spending money. This economy is still strong, so that's going to drive us, we think, still to new highs before this year's over, Jared.
All right, we're going to leave it there. Sydney, Ryan, thank you.
Thank you.
And that's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You could stay tuned for Market Domination with Shauna Smith and Josh Lipton coming up at 3 p.m. Eastern. You don't want to miss it.